The market is being aggressive on rate cuts, all right? And I believe that the Fed is going to take its time.
By the end of the year, they will start cutting.
Our core team has 4 cuts and 4 cuts, 24 and 25.
The 6 rate cuts, that's a pipe dream if we have a soft landing. That's not happening.
The market is now calling for a 175 basis point cut by the Fed. Really? How about this? No way. No way at all.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance alongside Lisa Abramowicz together with Annmarie Hordern. I'm Jonathan Ferro. Your equity market on the S&P 500 positive by 1/3%. Bramo leaving behind the doom and gloom of Davos. Welcome to New York City with equity markets at record highs.
Does it feel like record highs? That's what I would ask you, given the fact that if you look at equal weight, it's actually down on the year. You look at NVIDIA up 20%. Is this just NVIDIA driving the entire market up? And that, to me, is one of the big questions facing the market.
AMH, that's the markets. Let's talk about the politics, the political cycle, the gift that keeps on giving to the news cycle. The Republican race goes from 3 to 2.
Yep, then there were 2. So now we have really a head-to-head race in New Hampshire as we go into that primary tomorrow with Nikki Haley and former President Donald Trump. And DeSantis, in a 4.5-minute video he posts on Twitter deciding why he's backing out, he decides to endorse the former president.
That's the Republican race. We need to talk about what's happening with the president. The calendar, is it on his side? Consumer confidence Friday, Bramo, bouncing back. Inflation expectations coming in. Are we going to see more of that in the next few months?
The perfect soft landing. If you take a look at markets, that seems to be the implication as you see bonds losing value, but stocks gaining. Basically, we can exist at these types of rates and companies can still really accelerate and do well. Does this last? That's really the question. Can this last, or does something have to give? A lot of people seem to say a lot of things have to give. At Davos, not so much.
Let's take a look at the financial markets right now. Good morning to you all. Equity futures on the S&P 500 positive here by around about 1/3% on the S&P. In the bond market, yields coming in about a single basis point on a 10-year 4.11. That was not the story last week, Bramo. Yields higher across the curve.
And basically, this comes after a lot of pushback. You heard that, no way are they going to cut rates by 6 times. But at this point, it's good news for stocks, because even though you could see bonds blow out, you could still see stocks do well. And that seems to be the presiding sentiment for the moment. We shall see.
Howard Lutnick's welcome back anytime, right?
100%.
Anytime.
100%. Yes, exactly.
Just to push back against rate cut expectations. Coming up on this program, kicking off the week with equity markets at all-time highs on the S&P 500. It's quiet this week. Bramo, on the earnings front, it picks up next week with big tech.
We get a little bit of a teaser, though, with Tesla tomorrow. And then, of course, later on this week, we get Netflix. I am curious to see whether they can reprise some of the gloom that we've seen in those particular sectors. There's been a lot of splintering in big tech. Is this just AI and then everybody else, or is this still going to be the Mag 7?
We'll head down to Washington, D.C. in about 15 minutes' time. DeSantis dropping out of the 2024 race and endorsing Trump. AMH, we've got to figure out, is that good news for Trump or good news for Nikki Haley?
I think because of the timing as we go into New Hampshire, potentially it is good news for some individuals, for Nikki Haley. But the problem is he was polling about 5% in New Hampshire. So is that 5% enough for Nikki Haley? Because if you look at the CNN poll over the weekend with the University of New Hampshire, Trump is up 50% in New Hampshire. A lot of donors, I think, are giving her the grace period of New Hampshire. But if he wins New Hampshire, it's almost over for her.
Away from electoral politics, a focus on the Middle East this morning as well. The United States continuing to strike Houthi sites. This quote from the president, I found this absolutely stunning over the weekend. Are they stopping the Houthis? No. Are they going to continue? Yes. Can you make sense of that?
What they are trying to do is degrade the Houthis' capability of going after the ships. But until they potentially go after some higher level targets, the Houthis doesn't look like they're going to be stopping anytime soon.
This just is a tortured kind of balance to try to avoid some sort of larger altercation. That's what it feels like. Whether it's a clear strategy, not so much. At the same time, it's a clear aversion to wanting a broader Middle East war.
Jennifer Flitton of Invesco joining us in about 10 minutes. Don't miss that conversation on this. We begin with our top story this morning. Equity markets at all-time highs, but Gillian Emanuel of Evercore ISI saying be prepared for the volatility of an election year, writing this. Given that a momentum market can keep going until it stops, we want to own option convexity upside calls and downside puts. It is very difficult not to make money, whether you are a bear or bull, Democrat or Republican. Gillian Emanuel of Evercore joins us right now for more. Gillian, good morning to you, and thanks for being with us.
Pleasure.
First guest in our brand new studio. Thank you very much. Let's get straight into it. Can you make money this year in an election year? and ignore the politics simultaneously?
You can't ignore the politics. Obviously, the cycle will not allow you to ignore the politics. But from our perspective, again, if you look at the last several weeks, you have what you had once again, I think, back towards the summer of last year, the momentum trade really dominating all, and obviously generative AI, which we believe is a very viable long-term theme that is going to be embraced around not only corporate America, but the entire world as a productivity enhancer. But every now and then, things get ahead of themselves. And to us, this is one of these times where, look, the teasers talked about too many rate cuts being priced in, too much earnings anticipation being priced in, and all of those are likely going to cause a bit of a pause here.
You sort of put a number on that, 10% decline, a potential correction in equity markets. What do you do with that if you're bullish long-term, or kind of bull and bear, Republican and Democrat, just sort of watching everything and saying, I'm going to still make money? How do you make money if you're expecting a correction?
Well, option hedges are extremely inexpensive, given not only the volatility that we've seen in the last couple of weeks, but the volatility that is typical of this kind of year when the balance of power coming into the election year is as tight as it is. But what we would say here, and this is the type of conversations that we're having with clients, is that it's less about the defensive aspect and more about staying invested in themes that are likely to work. And to us, that is communication services, that is healthcare, that is consumer staples, in anticipation of a more advantageous time to deploy capital, which we think comes later in the year.
Do you think that what we've seen with bonds underperforming and stocks outperforming can continue over a longer term? Or do you think that this is sort of the beginning of that reset? It's kind of a sign to you that we're going to see that correction that you're expecting?
So we have to go back to the 90s. A lot of what's happening really has reference to the 90s. There was a lot of money made in stocks with yields and interest rates at these levels. It's less about where, are we going to revisit 5% again in the 10-year yield? That's not likely, given, in particular, our call for a slowdown in the economy at mid-year. But frankly, if the volatility in the interest rate markets calms down, that is a better sign for an equity investor in terms of understanding risk reward.
Let's go back to the start of the year. You put out a note and you say, what can shake the nothing can go wrong optimism? Let's talk about everything that has gone right in the last week. Retail sales came in hot. Jobless claims came in much, much lower. Then you look at consumer confidence picking up and inflation expectations falling. Isn't everything just kind of going right to start the year?
It is at the moment. There are only a couple of sort of ancillary points. Empire Manufacturing Survey, quite weak. The ISM services verging towards that 50. But, frankly, the concept of the slowdown, the non-soft landing, is still on the shelf for now.
You got to the essence of it. Last week was a clean sweep. You look at the rest of the economic data over the last couple of months, you see some conflict. How much of the economic data that you look at on your dashboard at the moment is in conflict?
It is a small but slowly building number. In fact, Evercore ISI's proprietary corporate surveys have started to show a little bit of weakness, that there was some stability and some advance in and around the holiday season, which is why I think, again, a lot of these confidence measures are really sort of more coming off of the holiday season. Let's see how that evolves into February.
Julian, you talk about volatility with an election year, but you're also overweight defense stocks. Would that change if we were to see Trump back in power and take a more isolationist approach?
Well, I think that there is a bit of a conflict in terms of how the sectors are likely to perform. If you look at the last two election cycles, there was, a deep ratification of the more industrial type stocks and sectors. But actually, when you think about this year, again, we go back to this idea that what's driving the market right now is very much concentrated around AI. And the way we know that is if you look year to date, the more economically sensitive sectors, consumer discretionary, industrials, materials, all down on the year.
So regardless who wins, AI is the winner. Trump or Biden in the White House?
We think so. But again, this is one of these times where these things go in ebbs and flows. I'm reminded of the middle of 1999 when the NASDAQ pulled back about 14% on its way to a 100% rally, and a stock which has become, the world's most iconic stock, pulled in 29% to a split-adjusted price of 50 cents versus its current level, about $190 a share. You have to think long-term and be able to ride out volatility.
Julian, great to have you with us. You're going to stick with us. The comfort with AI last week in Davos was, I would say, unsettling from my perspective, just how comfortable everyone seems to be with the trajectory of that technology.
Because it's going to take over our jobs and potentially rule the world and undermine the financial system. Is that what got you concerned?
I think bottom line, it has the potential, has the real potential to do to services what globalization did to manufacturing. You couldn't trust government last time around. I'm not sure why you should trust them this time around.
Michael Spence pushed back on that a little bit.
Just a bit.
Just a bit. And I too, though, I mean, that was the subject of conversation this weekend with people in my family saying, isn't that going to be Armageddon for older people in particular? A lot of people push back on that. I agree with you. Where is the trust? Rebuilding trust was the theme, right?
When I say this to individuals, especially one I spoke to at Davos who runs an AI company, he says, no, Annmarie, we're not trying to put you out of business. We're just trying to enhance your job. We're going to make it easier for you to do your job. But it is a little bit concerning.
Yeah, before we see some computerized Annmarie Hordern doing the news and someone programming it in the control room, like we're this close to that. OK, let's take a look at some of the top headlines from stories elsewhere. Let's catch up with Danny Berger with your Bloomberg Brief. Morning, Danny.
Good morning, John. Florida Governor Ron DeSantis has dropped out of the 2024 presidential race on Sunday. Now he's endorsing Donald Trump. DeSantis exits the race just 2 days before the New Hampshire primary. Former UN ambassador Nikki Haley is now the second-place candidate. The latest Emerson College polling shows Trump leading New Hampshire with 50%. Haley is at 35%. Macy's has rejected a $5.8 billion takeover from investors Ark House Management and Brigade Capital Management. The offer, initially made last month, represents a 19% premium to Macy's closing price on Friday. Macy's board declined to provide due diligence to Ark House and Brigade. Ark House says it is, quote, highly motivated to make a deal. Spirit Airlines says its deal with JetBlue remains, quote, in full force and effect as the carrier looks for ways to shore up its liquidity. The discount airline also plans to refinance its debt. It's an effort to ease anxieties over the merger fallout. Spirit says in a regulatory filing that a combination with JetBlue is, quote, the best opportunity to increase much-needed competition and choice. That's your Bloomberg Brief. John.
Hey, Danny, thank you. Appreciate the update. Up next on the program, DeSantis dropping out, endorsing Donald Trump.
I am today suspending my campaign. I'm proud to have delivered on 100% of my promises, and I will not stop now.
That's coming up next. You're watching Bloomberg Surveillance.
The 2024 nominating contests are here, and the candidates are making their cases to New Hampshire voters ahead of the primary.
And we're off to New Hampshire.
Bloomberg is live in the ground, bringing you the fastest news.
Trump is leading by a long shot.
Insightful interviews.
These candidates are trying to target independent voters.
And the most informative analysis about what it all means for November's presidential election.
What is your path to the nomination?
Coverage continues today, only on Bloomberg.
Live from New York City this morning. Good morning. Quick check of the price action for you on the S&P 500. Equity futures positive here by 0.33%. Yields a little bit lower. We're down 2 basis points on a 10-year, 4.1%. Under surveillance this morning, DeSantis dropping out, endorsing Donald Trump.
I am today suspending my campaign. I'm proud to have delivered on 100% of my promises, and I will not stop now. It's clear to me that a majority of Republican primary voters want to give Donald Trump another chance. I signed a pledge to support the Republican nominee, and I will honor that pledge. He has my endorsement because we can't go back to the old Republican guard of yesteryear.
Here's the latest this morning. The race for the GOP nomination down to 2, just ahead of the New Hampshire primary. The latest polls show Donald Trump widening his lead. Nikki Haley intensifying her attack on the former president, saying, quote, we're seeing he's just not at the same level, Annmarie, as he was back in 2016.
Yeah, and a lot of people are talking about that video of him over the weekend when he kept talking about Nikki Haley, but he meant Nancy Pelosi. But everyone today, Jonathan, in Washington is weighing on DeSantis dropping out. The Wall Street Journal themselves, their editorial board, saying, quote, does Mr. DeSantis have a presidential future? Perhaps. He's not a winsome political personality, but he has an excellent record in Florida. Republicans gamble on Mr. Trump again. Win or lose, the former president can't run again. Maybe then Mr. DeSantis will offer a conservative vision that offers more than second-string Trumpism. His biggest problem was he wanted to be Trump light. But the MAGA base, 30% of the party, wants the real deal.
This campaign started absolutely terribly, and Lisa just never picked up, did it?
And there were all these sort of postmortems talking about the infighting and the financial problems and some of the lack of direction, not to mention how do you fight back against somebody who you aspire to be? All that we can say is now the question is, A, is he on vice president watch? And B, does this help Nikki Haley or does it help the former president more? And that really is yet to be determined.
Let's have that conversation right now. Joining us is Jennifer Flitton, the head of U.S. Government Affairs at Invesco's. Jennifer, great to catch up with you. Let's start there. Whether Nikki Haley can really close the gap with Donald Trump.
Yeah, it's not looking good, right? I mean, those polls that you were referencing showing that most of those votes are probably going to go to Trump from DeSantis. And so that double-digit lead that Trump has going into New Hampshire, the momentum is behind him. And it's going to be potentially a difficult decision after New Hampshire if Haley doesn't get within at least 5 points of Trump.
So when does she drop out then if Trump does take New Hampshire, Jennifer?
Well, that's the question. That's exactly it. Because it's then really a month until South Carolina. And we have Nevada in between, but their election with the primary versus the caucus is now kind of put them off to the side. And so on February 24th, you have South Carolina. Now, if she comes within 5 points of Trump tomorrow, she could have some momentum, some real wind to her back. And that could keep the money flowing, which is really important going into South Carolina, which is her home state. But if her numbers continue to show that South Carolina isn't really in play for her, that could be embarrassing. And so she'll have to take that into account when making her final decision.
Well, does she even go for South Carolina if the polls were to remain as they are today in her home state? And of course, Senator Tim Scott decided to endorse the former president, and she's losing that state at the moment by more than 20 points. Is it safer for her to back out before she has this embarrassment in her home state?
Yeah, no, I think you hit the nail on the head there. Conservatives in South Carolina, right? And New Hampshire is much more independent. I mean, when you go into South Carolina, you're looking at a more traditional Republican base. And her numbers are not as good in South Carolina as they are in New Hampshire. And you mentioned Tim Scott endorsing Donald Trump, but also it's the governor of South Carolina endorsing Donald Trump. And most of the members of Congress, I think only one endorsed her. And so you have a real momentum there for Donald Trump in South Carolina.
Jennifer, is Ron DeSantis gunning to be vice president?
I don't think so. I think Ron DeSantis is looking to 2028. I think he is, young, 45 years old, and he sees a political future for himself, but I doubt it's running alongside Donald Trump.
Meanwhile, there are some things that have to get done, like passing a budget and dealing with national security concerns. And there seems to be a bit of a stalemate, although some progress. What do you think are the chances of, yes, getting a bill passed to get some sort of spending done this month, but that also can carry through to March, to February, to March, so we don't end up with this just on repeat again and again and again with more acrimony each time?
Right. So they were able to pass a CR March 1st and then March 8th. It's still sort of staggering those appropriations bills. And Schumer and Johnson were able to reach a deal on a top line spending number, but they still need to get those 302B numbers. And those are the numbers that are the thresholds for each of the individual 12 appropriations bills. That's going to be on the shoulders of the appropriators over the next month in order to reach that March 1st and March 8th deadline.
Jennifer, I want to turn to what's happening internationally and finish on these strikes on the Houthis in the Middle East. The president was asked about these strikes over the weekend, and he gave, I would say, an almost bizarre response, but I guess he said the quiet bit out loud. Are they stopping the Houthis? No. Are they going to continue? Yes. Why would they continue if they're not working?
Yeah, and I think you're seeing a reaction from Congress with the same sort of questions right now. And he's getting hit from Republicans, national defense Republicans, who are real defense hawks, and wondering why the incremental sort of approach to what is happening in the Middle East and in the sea there. That will only increase. And I think you're going to see a number of hearings and a lot of focus and spotlight from those committees of jurisdiction when the House returns after next week.
Jennifer, appreciate the update. It's good to catch up. Jennifer Flitton there of Invesco. Still with us around the table, Julian Emanuel of Evercore. Julian, I won't talk to you about the strikes and why they're not working. I will talk to you about the consequences. We've got traffic through the Red Sea down, traffic through the Panama Canal because of what's happened with water levels down. How close are we to goods inflation picking up again because of what's happening around the world?
Well, I think that is one of the things that sort of bother us about being ultra aggressive to the upside in the markets here is that part of this expectation is that inflation is going to continue that gentle glide path lower. And I would suggest that what you may end up seeing is if you have continued congestion, this could be an environment where the stickiness does remain, but in fact, it ends up being manifested in incrementally lower demand, particularly given that from our point of view, you're likely to have the end of the pandemic excess savings at some time this year.
Can you just talk through what signals you're looking for that could trigger that 10% downturn that you're looking at?
I think the biggest would be an interpretation right now as far as news amongst the generative AI names. If you see earnings, and earnings has been a sort of a puzzlement thus far. Obviously, you've had mixed results. It looks like this is shaping up to be not so great a quarter. But what's really important is, again, as much of the last year, how the stocks react towards the earnings numbers. And it's not at all clear, given the run we had, that there is much more upside, even if you get the beats that are expected.
Julian, to John's point, at this moment, isn't someone's bottom line being hit by the fact that ships are having to take a much longer route and a more expensive route going around Africa?
No question about it. And if you go back and you think about those kinds of distortions in the pandemic, right, is that you still had the demand there because we didn't have anything else to spend our money on. And so from that perspective, I think we're just in a different state of affairs. There could be this stickiness to inflation, which of course makes the Fed's intended path a bit more trying, but ultimately it could wind down into slightly diminished demand.
Julian, just quickly before you run, favorite trade this year, what is it?
Wow. So we really like the names, and it's across a variety of industries that are taking generative AI and actually figuring out how to make it work. It's not just the cost savings. Obviously, that's, when you think about the financial industry commentary, they are the vanguard of the cost savings in this environment. But it's also the consumer companies who are becoming much more adept at connecting their clients, taking information, and importantly, asking the right questions to make it all work.
Julian, thanks for the insight this morning. Appreciate
Pleasure.
it, buddy, as always. Julian Emanuel of Evercore. Let's check out the markets for you. About 3 hours and 5 minutes away from the opening bell. Equity futures shaping up as follows on the S&P 500, pushing a little bit higher by 1/3% after closing at all-time highs on Friday's session. 2 weeks of gains on the S&P. Can we add to it this week? Coming up on the program in about 20 minutes' time, we'll catch up with Stephen Major of HSBC on the global fixed income market as we wait for this week's ECB rate decision. Bramo, I have to say, it feels like we've had 2 ECB news conferences in the last week already, doesn't it?
We did. I mean, basically, Christine Lagarde gave a preview of it and had some spicy words about Trump, so maybe she'll, give a repeat of that, as well as pushback.
3 or 4 different press conferences with Christine Lagarde in Davos, Switzerland.
Yeah,
there's another one still to come this week. From New York City this morning, good morning. You're watching Bloomberg Surveillance. Live from New York City this morning. Good morning. 2 weeks of gains on the S&P 500. Looking to kick off maybe potentially a third week of gains. In the equity market right now, the S&P positive by a third of 1%, on the Nasdaq up by 0.6. The Russell picking up here by 0.4. Attention turning away from the financials. We had earnings from Goldman and Morgan Stanley last week. Attention turning towards what we hear from big tech over the next week or so. Early February, Lisa, Apple on deck.
And before that, we're going to get Tesla, we're going to get Netflix, and that's going to be this week. Honestly, this to me is going to be the real kahuna, given the fact that any kind of gains have been entirely from these stocks. I mean, it's kind of shocking to see the Russell 2000 still in a bear market, even as you see new record highs for the S&P 500.
Amazing to see all-time highs on the S&P 500 on a week where yields were pushing higher. 2-year, 10-year, 30-year looks like this. The 2-year currently 4.3825. We're down a couple of basis points on a 10-year. Let's call it 4.1%. Last week, we had pushback from Governor Waller against rate cut talk, reinforced by hot retail sales, lower jobless claims, consumer optimism picking up. A lot of reasons for high yields last week.
But this all came from the strength that's supporting the equity markets. Mark Heffley of UBS earlier this morning was talking about how this is the beginning of bonds and stocks having their inverse relationship, and it's going back to normal, and you can have a balanced portfolio. I don't know what to think of that. I'm kind of struggling with that because, honestly, this seems like a sweet spot that could push either direction pretty quickly.
This is the United States. We need to talk about Europe as well. The data, not great at all. The euro looks like this against the dollar. Euro-dollar at the moment, 108.85, negative about 0.1%. Joked about how many times we heard from Christine Lagarde, the ECB president, just last week in Davos, Switzerland. Elisa, not entertaining the rate cuts by quite the same degree that the market seems to be.
But she did say that by the summer, and previously she hadn't said they were in the equation. So will she push that forward, given the fact that you do have disinflation and you do have a bit of softness, particularly in Germany? We're going to hear from her again in the 5th press conference in the past 2 weeks. And that's going to come on Thursday. How much she's going to really just echo what we've heard from Jay Powell remains to be seen.
And the Federal Reserve is just around the corner as well. Under surveillance this morning, your top headlines. Florida Governor Ron DeSantis dropping out of the 2024 presidential race and endorsing former President Donald Trump. DeSantis leaving the campaign trail just before voters take to the polls for the New Hampshire primary tomorrow. The stage now set for a two-way race between Trump and Annmarie, the former UN ambassador, Nikki Haley.
Yep, then there were two that's left in this race. DeSantis dropping out. You know, I spoke to someone from his campaign last night, and they said there was just no path forward. And now everyone, Lisa, you mentioned, is going to do these postmortems. But he peaked before he entered. Remember, he was leading Trump this time last year. And then, of course, he had that botchy release on Twitter. And really, for then, it's been all downhill.
And he wanted to say he broke the internet, and everyone said, no, it just broke. So Nikki Haley, though, of course, now saying, you know, may the best woman win. And now it's just a lady and a guy that's going to be in the race. Let's see if she can galvanize. What I'm curious is, what is the threshold for her to drop out? Because right now, it doesn't seem like there's a real path. So how big does the gap have to be when Trump wins? And how big does her loss have to be in South Carolina? That will be a humiliation.
But does she make it to South Carolina? Because
you think there's a chance she won't?
It could be quite humiliating if she loses her home state that she once was a governor at.
What do the polls look like right now?
Not good. Double digits. Trump is leading her in South Carolina if you look at the Real Clear Politics aggregate of all these polls. And, you know, to our earlier guest's point, it's not just Senator Tim Scott who's come out and endorsed Nikki Haley. It's the current governor who's endorsed former President Donald Trump. So she's really up against a tough fight in South Carolina, and maybe she wants to save herself from that embarrassment.
At the same time, the reason why New Hampshire is interesting is because independents can vote. So it maybe is her as a centrist candidate trying to pose the best opposition to Joe Biden, and maybe she can make that pitch in a new kind of way.
Let's turn to the second story. The latest update in the Middle East. Israeli Prime Minister Benjamin Netanyahu rejecting a deal with Hamas to release all remaining hostages in Gaza. Netanyahu saying in a video address that Hamas is demanding a withdrawal of all forces in Gaza and a release of militants responsible for the attacks in October. Public pressure ramping up for a deal to bring the remaining 132 hostages home, ramping up domestically and internationally as well, Lisa.
What strikes me as really compelling, what I'm watching, is this idea that the Israeli foreign minister is over in Europe making their pitch. And Europe is really having some harsh words with Israel, saying, if you're not on board with a two-state solution, then we can't help you. And Biden kind of splintering from Netanyahu at the same time that Netanyahu's losing a lot of popularity. I want to see whether they're going to hold elections. There's a lot of internal push for that could potentially kick Netanyahu out of office.
When it comes to the hostages, more than 100 individuals are still being held by Hamas. This is going to be a huge focus for the administration this week. Axios over the weekend saying Biden is sending Brett McGurk over to Egypt and Qatar to try to negotiate this deal. It's not just domestically that they want to get those hostages out. This administration looks like if they can get the hostages out, potentially that can lead to a ceasefire. And it just further puts a little bit more pressure on Netanyahu.
Biden's been absolutely hammered on this issue within his own party over the last 3 months. At the start of this campaign, we saw the two leaders standing shoulder to shoulder. How much space is there? How much daylight is there now between Netanyahu and President Biden?
It's a big gap. You know, we saw Biden take a trip to Israel and give this bear hug to Netanyahu, an individual where they had a lot of friction leading up to that moment. And now it's becoming more troublesome for this administration, so much that this aid that's caught up in Congress, you have people in his own party saying, we are not going to deliver that aid to Israel without some strings attached.
Speaking of trouble for Boeing, the FAA expanding inspections to another Boeing 737 that has mid-exit door plugs, the same type involved in the Alaska Airlines blowout earlier this month. Boeing saying it fully supports the order to inspect the 737-900ER, an older generation of the MAX family. Federal regulators have yet to say when grounded 737 MAX 9 jets, Lisa, can resume flights.
I honestly don't know how things could get worse. I mean, a couple days ago, there was a video of a cargo plane, a 747 Boeing jet, on fire, literally on fire. And some of the rhetoric, oh my God, it's on fire. On social media, people posted these videos. It's just piling at this point, especially with this particular investigation. Boeing shares down more than 17%. How do they revive some sort of trust? How do they revive some sort of confidence when it's one thing after another, this sort of trickle of bad news?
Confession flying back from Switzerland. And you guys know this. I didn't take the window seat. I took the aisle with this in mind, which is kind of pathetic, I know, but ultimately it was on my mind, and I'm sure I'm not the only one.
Well, I checked to see whether it was a Boeing or Airbus for the first time ever.
What was it?
It was an Airbus, and it made me feel a little bit better. I mean, that's the
not
truth.
Good.
It's not good, and it's probably not logical, but there you go.
I had the same idea, but I didn't check, because I knew it would just give me a lot of anxiety if it, in fact, was a Boeing.
Speaking of Davos, Switzerland, a conversation that came up repeatedly last week, the reality check for EVs. Just 3 years ago, the White House went all in.
The future of the auto industry is electric. There's no turning back.
But now the auto industry is turning back. Rivian's EV deliveries falling short of estimates, Hertz offloading a chunk of its EV fleet, and Ford cutting production of its F-150 Lightning. Joining us now is Bloomberg's Craig Trudell. Craig, let's get to it. How much of a reality check have we seen in the last week?
I think the last week has been extremely eventful, but also just the last few months where we, take a look at what has happened at Tesla, the amount of price cutting that they did last year for sort of incremental gains in volume, and the extent to which that has sort of reverberated for the rest of the industry. I think we saw that in Hertz. We've seen, Ford maybe going from potentially, fearing the arrival of the Cybertruck and the potential threat that posed to the F-Series line, and perhaps not being as afraid of the sort of competitive blow that could come from that. And also, let's be honest, some of these companies really struggling with execution issues. I don't think that we can sort of absolve some of these companies of some of the failures they've had to take a Tesla on. As much as they're having some challenges of lately, they're still, really sort of in a two-horse race here with, Tesla and BYD being way out in front of the rest of the industry and making this transition to electric vehicles.
Craig, you mentioned BYD, and that's where I want to go. How much of the pullback from the electric vehicle space by American manufacturers really comes from the threat that Chinese manufacturers can sell EVs so much more cheaply, and as soon as they come to the shores of this country, prices are going to drop really considerably?
Yeah, I don't think they will come to the U.S. in part because of the trade barriers that have already been set up, and we've heard rumblings of the Biden administration, even raising tariffs that are already sort of prohibitive. I don't think the Chinese manufacturers, including BYD, really see this as making any sense trying to enter that market in the near term. But I do think that we will see, a lot of politicking around this and sort of messaging around the idea of, do we want to go the way of losing out to the Chinese? And, both sides of the political aisle will sort of fight on the basis of, do we want to sort of fold to the Chinese if you're a Democrat? And on the right, do we want to go in the direction of electric vehicles when the Chinese are so dominant? And so, it will be, sort of different messaging, but both will surely, sort of cast China as the boogeyman here to either, take on or sort of avoid.
Craig, I'm struck by the fact that Ford, yes, is pushing back some of their targets, but they still have targets of electric vehicle adoption in a much more mainstream way. From what you gather, do you think that this is an interrupted transition to electric vehicles or just simply a delayed transition?
I think more so the latter. I think what we've seen sort of the established car makers learn is that, doing a sort of slapdash effort of taking, an existing platform, in Ford's case, only slightly altered version of the F-150 and sticking a battery in it, that is not the way to sort of make a compelling electric vehicle. And I think we saw an effort on Ford's part to really sort of place speed ahead of anything else and really get to market ahead of GM with the electric Silverado, to take on the likes of Rivian and the Cybertruck, and some shortcuts that were taken that led to some compromises in terms of how well the F-150 Lightning performs. And so what we're going to see in the next couple of years is these car makers bring to market dedicated platforms that from the ground up were purpose built to be electric. And we'll see, I think, much more compelling vehicles. The question, of course, is whether that will be enough to bring the consumer, who's proven difficult to sort of get to come around to electric vehicles, whether that will be enough to sway them.
Craig, we spoke to John Kerry last week, and he said that it's, quote, disinformation on why consumers are not catching up and being persuaded to electric vehicles. And at the same time, on Friday, a Biden administration official came out and said more needs to be done when it comes to the charging stations, because that is a real concern. So which one is it?
I think, honestly, it can be both here, where there is a lot of, I mentioned the word boogeyman earlier. There's some really strange, sort of anti-EV messaging of, just how clean are these, or, this idea that you can't possibly, get by with the charging infrastructure where it is. Does there need to be a lot more progress in this regard? Absolutely. Are there people just, all over the place running out of juice and stranded by the roadside? No, that's not the case either. So, there is some truth somewhere in the middle here. I do think, the industry is going to go in this direction and needs to figure it out. I also think, it's going to be really interesting to see just how much this compromise of making the transition to Tesla's charging standard will help some of these manufacturers. That was a big, deal last year with a lot of announcements, but we won't see that actually come to fruition, until the coming months. And so whether or not that will help resolve some of these charging issues for these other manufacturers will be something to watch.
Hey, Craig, appreciate the update, buddy. It's good to catch up. Abramowicz, I struggled with it. I struggled with it in the conversation with Secretary Kerry that somehow range anxiety is the consequence of a misinformation campaign.
Well, to Craig's point, I don't think that people are necessarily worried about getting straight out of the side of the road. However, honestly, I was going to rent a car, and I didn't rent an electric car because I didn't understand where exactly the charging stations would be. So I just decided, you know what, I don't really want to complicate my vacation, explaining why perhaps some people are selling.
Clearly, you're not alone, which is why Hertz dumped 20,000 EVs.
Exactly.
Well, yeah, but in Italy this summer, I rented an electric car, and there's apps set up to charge them, and it was actually quite simple and easy. Italy has put a ton of money into the south of the country to try to ramp up a lot of this. They're hosting the G7 in Puglia, but you need the charging stations in order for this to work. And if you don't have it, it's quite anxious.
I think we've said this repeatedly. It's not that we're rethinking the destination. It looks like that's locked in based on what governments would like to see. This is about the pace, the speed we get there, Bramo.
Yeah, but the problem is that if you conflate the two, you end up with real mixed messages, right? Which really comes from things like pumping more than 13 million barrels of oil a day and then talking about the evils of fossil fuel creation and emissions. So this, to me, is what is it? How do you have clarity of message while recognizing the necessity of a longer period of transition?
There's a bit of tension between those two ideas, just a little bit. Let's get you up to speed on some of the headlines from stories elsewhere this morning. Let's say good morning to Danny Berger. Morning, Danny.
Good morning, John. Elon Musk is set to visit Auschwitz and attend a panel on online anti-Semitism. It's part of a trip organized by the European Jewish Association. The EJA organized the visit to address a worldwide surge of anti-Jewish rhetoric that followed Israel's invasion of Gaza after Hamas's deadly attack on October 7th. Musk caused an uproar in recent months after endorsing an anti-Semitic Jewish conspiracy theory on X. Frigid temperatures are still gripping much of the U.S., with states as far south as Texas and Florida feeling the freeze. Sub-zero conditions and dangerous driving conditions claimed 72 lives nationally after significant snowstorms blew through eastern states. Freezing temperatures are expected, though, to ease up in the coming days. And the Kansas City Chiefs advanced to their 6th straight AFC championship with a 27-24 win over the Buffalo Bills on Sunday night. The Chiefs ended the Bills season in 3 of the past 4 playoffs. Now the Chiefs move on to Baltimore to face the top-seeded Ravens. And that is your Bloomberg Brief. John.
Danny, thank you. Impressed that we got through that without mentioning a certain name. AMH.
Taylor Swift.
Just about
She was in
through it.
attendance. She was in attendance.
Just
But I
about
was
got
voting
through
for
it.
New York.
Were you?
Rooting for New York, yeah. I don't really follow football, but I rather the Buffalo wins over Kansas
Okay,
City.
great, yeah. All right. Appreciate the insight. Thanks, AMH. Up next on the program, the Fed dialing back rate cut expectations.
We don't want to loosen policy too quickly, only to find that inflation gets stuck at way above target. That would be a miss.
That's coming up next on the program. You're watching Bloomberg Surveillance. Live from New York City this morning. Good morning. Equities look like this on the S&P 500, higher by 1/3 of 1%. Equity futures in positive territory. Yields are a little bit lower, down by 2 basis points, 4.09%. Under surveillance this morning, the Fed dialing back rate cut expectations.
We don't want to loosen policy too quickly, only to find that inflation gets stuck at way above target. That would be a miss. That would be a very scarring miss. And we don't want to try to get to 2 so quickly, like overnight, just to get that squeezed out, that we end up having this big run up in the unemployment rate.
That was San Francisco Fed President Mary Daly speaking at the San Diego County Economic Roundtable on Friday. Bramo, we heard a lot of that last week.
The sort of perfect balance, but how do you get there? And I think this is the angst. How do you know when you're actually at that perfect balance, given the fact that the hard data looks pretty good? Patrick Harker of Philadelphia Fed came out in a January 18th essay. I thought this really was fascinating, and it has reiterated what he's told us before as well. He said he'll be guided equally by the soft and hard data, writing, quote, "As important as the hard data are, they do not tell the complete story. Soft data help not only better explain what I may be seeing in the economic updates, but can also give me insights of emerging issues that may not show up in the numbers until further down the road." John, this to me is one of the key questions. What are the indicators, the tea leaves that some of the policymakers are looking to know when to make a move?
Anecdote. Patrick Harker, you remember this, Jackson
I remember
Hole.
this, yeah.
We sat down with him and we talked about exactly this, what businesses were telling him on the ground.
He said that was a better indicator when we saw the turn of inflation, when we saw the turn of things going up, than a lot of the hard data. So now my question is, what is the soft data they're looking at? People, businesses telling him that they're not looking very good? Well, actually, they are kind of optimistic. So where's the dissonance here that causes them to cut rates?
Let's see if Steve Major's got an answer, the Global Head of Fixed Income Research over at HSBC. Steve, great to catch up, sir. As always, let's go there. What's guiding you? What's your North Star right now on your dashboard, the economic data that you're looking at?
So the hard data is backward looking. The surveys can be unreliable, and anyone who's taken a survey recently after having a particular service will know what I'm talking about. People are fed up with them. So I'm not sure about the quality of the soft data and the so-called forward-looking data. For me, what matters more than anything else is the distance between today's policy rate and the longer run equilibrium. It's about 3%. I'm not that interested on the date and the amount of the first rate cut, which seems to be where most people are. The next move is down. It's either unchanged or down, basically. It isn't up. And that binary outlook for rates makes it much easier to justify a long position in bonds than it did maybe 3 to 6 months ago.
At the same time, Stephen, if they don't cut rates until December, that's going to surprise the market to the downside. So how do you sort of justify being bullish now when we're already seeing a lot of it already being priced in and people getting ahead of themselves?
Yeah, so we've got a neutral call for this month, and I tell my colleagues, look, if it's so obvious we're going sideways for 6 months and then the yields are going to go down in the second half of the year, what are we waiting for? Because you've got the carry and the coupon in the meantime. In the biggest period, the biggest bear market for bonds was in the period 1961 to 1980. the annualized total return was still positive. It was about 4% a year. Now, that kind of thing happened last year. You ended up with plus 4% on the year. At one stage, you were more than minus 10. But that's kind of how bonds work. So, yeah, I get the idea, Lisa. If they don't cut in 2024 for whatever reason, then the 2-year yield should be nearer to 5, and that could push the 10s nearer to 4.5. But that said, they might cut an awful lot too. So you have to balance those two scenarios.
At the same time, we're getting $162 billion of Treasury auctions this week, I should say, 2-year, 5-year, and 7-year. When do we start to worry about supply, especially as quantitative tightening continues?
You know that we get that question quite a lot, and you probably know where I'm going to come from here. The supply side is just one angle in the whole picture. The demand for bonds today is higher than it was 3 months ago, and that's a paradox because yields at 5%, it seems, were less attractive than yields at 4%. I hope I'm making sense, that there is more demand for bonds today than there was back then. That's because you've got the certainty around the outlook. Rates aren't going up. They're going to be unchanged or down. You couldn't say that for sure 3 months ago. That's why 10-year yields are about 100 basis points less. So there's $5 trillion or so sitting in money markets. Pre-pandemic, it was what, 2.5? So presumably some of that money is now shifting into bonds, or soon will be, because there'll be a huge regret if it stays in money markets and the Fed's cutting.
Steve, you wrote about this in the last 6 months. Does supply matter? We need to talk about supply relative to the cycle. How rare is it to see a deficit this large, Steve? To see issuance that Lisa just went through, with unemployment still south of 4%?
I had a bit of mea culpa last year, you probably remember. I mean, I underestimated the surge in supply, but the context matters. The increase in coupon issuance for the August to November period happened when the curve was deeply inverted, about minus 100 between money markets and bonds. And the US had just been downgraded by Fitch at the beginning of August, and the GDP holding up. Now, the confluence of those three events made it very difficult to justify buying 10s when money markets were 100 basis points higher. Today, you've got different circumstances. We're chugging along, but we're probably closer to the recession. You haven't got such a great inversion. You don't have the downgrades. So it seems to me that the supply is coming into a much more willing demand environment. So you could look at it from the money sitting in money markets. You could look at the level of equity prices. You could look at what overseas investors have been doing. You know, ultimately, we're going to be talking about the demand for bonds, not just the supply. And what I find interesting is how all the questions seem to be angled at just one factor, the fact that there's some fairly big supply coming up. Doesn't matter. There's plenty of demand.
Well, Steve, I wanted to get into that. Let's talk about both, not just the supply, but the demand. Has the playbook changed? I hear from you that you don't think it has, that we'll still be willing to finance this deficit when the economy rolls over and the tax receipts fall.
Yeah, we've had a couple of episodes that have made us worry. Obviously, I just pointed one out, that August-September period last year in particular. There was what happened in the UK 1 year before that. There's a UK fiscal experiment, but you've seen these things happen occasionally. I think taper tantrum was something similar, but ultimately these are short-term events. They don't determine the long-term value of a bond. A bond's valuation is mainly driven by the short rate and its expected path. Now, what's happening is people are stacking on a load of term premium onto their projections here, which is all very well, but it's just the majority of the bond's value is explained by the short rate.
I can tell that Steve is
this term premium thing.
Frustrated by that question that he's asked repeatedly about supply. Steve, in the heat of Dubai, we're not jealous at all. Steve Major of HSBC. Steve, it's good to catch up. Playbook, Bramo, hasn't changed for the team at HSBC.
Still looking long bonds. Yields are going to go lower, and that seems to be the conviction that continues.
It's that simple. Coming up in the next hour, Bob Diamond, CEO of Atlas Merchant Capital, for the entire hour, alongside Stuart Kaiser of Citi and Kelsey Barrow of JP Morgan.
The market is being aggressive on rate cuts, all right? And I believe that the Fed is going to take its time.
By the end of the year, they will start cutting.
Our core team has 4 cuts and 4 cuts, 24 and 25.
The 6 rate cuts, that's a pipe dream if we have a soft landing. That's not happening.
The market is now calling for a 175 basis point cut by the Fed. Really? How about this? No way. No way at all.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Travis Kelce and Taylor Swift chatting a commercial break. This show is going to kill me. Live from New York City this morning.
You're welcome.
Good morning for our audience worldwide. This is Bloomberg Surveillance alongside Lisa Abramowicz together with Annmarie Hordern. I'm Jonathan Ferro. Let's turn to the financial markets. Positive by 1/3% on the S&P 500. The last week, things have been decent. Retail sales were hot. Jobless claims were lower. Lisa, consumer confidence is picking up.
It all sounds so good. And at Davos, everyone was so optimistic. And then Max Kettner of HSBC with this cold water this morning. Don't jump on the Goldilocks train. U.S. large caps hitting all new time highs. We don't think this has much further to go.
MH, the president hopes it does.
Yeah, it certainly does. They want the timeline to be on their side. And I have to say, when the University of Michigan sentiment came out in that confidence report, I got a lot of messages from people in the White House sending me those news stories saying, look, people are starting to feel better about the economy.
Yes, but enough? That's the question. And do oil prices stay low enough to keep that confidence going? I mean, how much is that particular survey completely connected to gasoline prices in the United States?
I have a viewer writing into me this morning saying Exxon, Shell, all on Hillside Avenue in New York on Long Island, $2.99 this morning. That is huge. But to your point, that needs to be the price of gasoline next September, September, October, and November.
The White House wants to talk about consumer confidence. They do not want to talk about the 13 million barrels a day that's produced in this country that's keeping crude in the 70s and gasoline low, with the exception of one man. Secretary Kerry last week, what did he say? It was necessary. It was necessary.
Well, I asked him, is this a policy success or a policy failure? And he said it was a policy necessity because if you get higher oil prices, you end up with riots and a lot of social disruption. So here's the question. How do you dovetail a message of sustainability over the long term with reality in the short term, which is people are moving a lot less quickly than a lot of people had expected?
Brent crude right now just south of 80. The broader price action looks like this. In the equity market, a little bit of a lift on the S&P 500. Drifting higher here on equity futures. Yields drifting lower by, let's call it, 2 basis points. Down about 3 now, Lisa, to 4.09%.
Okay, still, we've seen a pretty big sell-off in bonds. And what I find fascinating is that we've reached all-time highs in NVIDIA, but also that has driven the rest of the index, while bonds have sold off. This, to me, is a huge question. Can this continue, given the fact that people are optimistic about the U.S. economy?
Coming up on the programme, that 2-week winning streak taking stocks back to all-time highs. The attention will turn for the financials of last week, Goldman, Morgan Stanley, to big tech of the next couple of weeks, Microsoft, Lisa, and Apple still to come.
Those, to me, are going to be the real determinants of whether we see some of this rally continue. The AI hype, can it translate into actual profits? Are they making headway, or are they just simply defending themselves from interrupters that are sort of going to change the way we search, change the way we do everything, change the way we are employed?
And then later in the programme,
potentially. Very dark. Well, I'm just saying.
Let's not start there.
All right, carry on.
The Republican primary narrowing down to just 2 candidates. AMH, it is Nikki Haley versus Donald Trump.
Yeah, I spoke to the DeSantis camp last night, or someone in the camp, and they just said there's no path forward. He tried to establish himself as someone like Trump, but without the baggage. That doesn't work when you basically have an incumbent in your primary field, Jonathan.
Yeah, well, honestly, I just am wondering who's going to be vice president, when Nikki Haley is going to drop out, and if this is going to be a Donald Trump-Joe Biden matchup. How many people are going to be excited? What's the turnout going to look for this thing that a lot of people aren't that excited about?
The turnout in Iowa was terrible,
yes.
But that was the temperature, so I imagine that's going to change.
It was very cold.
Well, yeah,
it was
but
absolutely freezing.
But there's not a lot of enthusiasm for this. And everyone who's come on, and a lot of people in private conversations, executives and beyond, saying, really, this is what we got, these 2 individuals, and a lot of people are kind of frustrated by that.
A final headline we need to hit a little bit later in the show as well. The United States struggling to contain Houthi attacks in the Red Sea. The president acknowledging, Lisa, that these strikes aren't working, but then basically explaining they will continue.
This is a really tricky moment. How do you prevent escalation at a time where you have to fortify the ability to trade in the sea, the independence and the safety of the sea? And this, to me, is going to be a quagmire that goes on for a long time. The tit for tat continues, and people shrug it off. It's just tit for tat, and it's avoiding escalation. When does that sort of trip some kind of wire, live wire.
We'll pick up on that story a little bit later this hour. We begin with our top story. Stocks trading at record highs as rate cut optimism is still growing. But Bob Diamond, CEO of Atlas Merchants Capital, warning the following. The Fed is likely to proceed with caution. A rate cut or even two this year could occur, but the economy is likely to continue to demonstrate that it can handle the current level of interest rates. Bob Diamond, I'm pleased to say, joins us now and joins us for the hour. Bob, good morning to you.
Morning, Jonathan.
Let's get into the data, and it's fantastic to see you, sir. Retail sales were solid. Jobless claims were low. Optimism is picking up. What evidence is that we are, quote, sufficiently restrictive at the Fed?
So, I think consensus, Jonathan, in my mind, is about 1% growth this year. The Fed is a little higher, kind of 1.5% growth. I think it might be a little bit higher than that. And as I look out at the year, if the Fed were to be aggressive in rate cuts, first quarter or second quarter, I think they run the risk of the economy accelerating a bit and therefore inflation accelerating a bit. And that's just a position that the Fed is not going to put themselves in. So my sense is that the right way to look at this, rather than the markets, or if you look at the Fed fund futures, they look at 150 basis points this year, and it's kind of front-ended. My sense is maybe one or two 25 basis point cuts second half, maybe closer to the end of the year. And I just believe the Fed, for very good reason, is going to remain cautious. They pretty much played a blinder since they recognized that inflation was spiraling, frankly, out of control not that long ago. We're in a very good position now. And I think for the Fed to act too quickly would put them in a difficult position. So our sense is the markets are well ahead of themselves in terms of rate cuts, maybe second half.
When you say markets, bond markets or stock markets? Because what I find interesting is how many people are saying this is a bond market problem. It's not a stock market problem, because if the economy is better than good, that's going to be positive for risk assets.
Yeah, and I think, Lisa, it raises another issue, which is we were for so long at zero interest rates or 1% interest rates. I mean, we all remember here world before 2008. From 2008 until very recently, Fed funds averaged about 1%. Before that, for decades and decades and decades, Fed funds averaged around 4% or a little above 4%. So where we are today is not abnormal. And our sense is that the economy is adjusted reasonably well. We see that in, kind of the calmness in the bond markets, the calmness in the equity markets. So there's not a panic here by the Fed to lower interest rates.
You were at Barclays leading the charge there for quite a while, Credit Suisse, First Boston. You've been in the banking business for a long time. There's a lot of angst about what the future of the banking industry is going to hold at a time where, yes, interest rates are higher, but also there's a whole host of regulation that's crimping the lending activities of a lot of these banks. You've referred to them as utilities. So where is the opportunity at a time where it seems like lending could be profitable if there weren't so many constraints?
So I think we're seeing, point one would be if you look at the U.S. banks, and if you look at what we typically report as earnings, we tend to report the big banks. And the big four, the big six in the U.S. continue to get larger, more concentrated than they were prior to 2008. And I think that concentration does weigh on me a bit. Do we really think that fewer banks, larger banks, more concentrated banks is better for the U.S. economy? I really don't think so. I think one of the things that's been the lifeblood of our economy, and the reason that the U.S. reacts so quickly to negative news and negative periods, particularly relative to Europe and other sectors around the world, is because of the diversification of the financial services industry. So I do worry about that. And I think earnings have been good, but the larger interconnected banks are becoming much more like utilities. And so the push back on higher capital levels, I actually think is going to be ineffective for just that reason, because the banks are becoming more concentrated and they are becoming larger.
So what do you think of this impact of these new capital requirements? If you like the U.S. regional banks, they potentially face even a tougher road ahead.
Well, I think a lot of that capital is for the larger interconnected banks, what people used to refer to as too big to fail. And I think that's where the biggest impact will be. And I can kind of understand both sides of that argument, Annmarie. On the one hand, the banks are saying higher capital levels, while we're safe right now, which they are, is going to lower ROE and reduce lending, which is true. On the other hand, if you're a regulator and you're worried about ever being in a position where there's systemic risk or too big to fail, even though the banks are doing great and they are safe today, the risk, if there was a failure of systemic risk, is greater. In my view, and this does fit my book, we really love to invest in the regional banks, and we're looking at it. So I want to claim that that's kind of our bias. But there's 4,000 or so regional specialist banks today. There's no country that has that kind of a financial services industry and that kind of a reach. The benefit that those banks have for small family-owned businesses, which again, the lifeblood of the U.S. economy, is really important. There will be consolidation, and I do think that those banks are reacting well to higher interest rates now versus, the immediate impact of higher interest rates. So we think there's going to be terrific opportunities in regional banks. We love that as a space to invest in, but most importantly, we think it's incredibly important that we provide opportunities for those institutions to continue to grow and serve small and medium enterprise businesses.
Based on that, it sounds like you think we're through the storm of last spring.
In terms of regional banks, yeah, for sure. I think there were a couple of things, Jonathan. I think every bank, large, small, medium, had to adjust their portfolio to higher rates. When rates go from 1% to 5%, it's going to impact. You can't have a positive impact of that. You have to weather it. And I think that's been managed pretty well. I think the second thing is there's been a lot of worry about the loan portfolios, particularly commercial real estate. And I think we're beginning to recognize that for many of these regional and more specialist banks, their focus on commercial real estate is more in small cities around the country as opposed to New York or LA. So I think the markets are getting more comfortable that the crisis is behind us. But I do think that there's an opportunity for consolidation. The impact of regulatory capital, the impact of regulatory intrusion post-SVB is increasing costs. I think the higher interest rates for a while increase costs. So some of the very, very small regional and specialist banks, although very, very sound, are going to really struggle to get the ROE to appropriate levels. So we'll see some consolidation there.
Just quickly, language matters, investing versus buying. Would you be interested in taking over a regional bank in the United States of America?
As an investor, would I love that as opposed to an operator? We do think of ourselves not just as investors, but as operators. And so if we make a significant investment in an institution, a regional bank or Panmure Gordon, as you and I have talked about in the UK, staying as non-executive, staying as investors, we can still have a pretty positive impact on the growth. And that's how I look at it. Would I love to get really, really involved with a couple of regional banks? Absolutely.
Absolutely. Yeah. Where would they be if you identified one?
I can't say that.
I'm trying to get to it, Bob. We're trying to tease this out in this program.
Very good question, though.
Well, you've got a couple of minutes to chew over because you're going to be with us for the next hour. Bob Diamond is potentially looking at buying a regional bank in America, but can't say too much. Let's get you some headlines from stories elsewhere. Let's catch up with Danny Berger. Morning, Danny.
Good morning, John. Florida Governor Ron DeSantis has dropped out of the 2024 presidential race on Sunday. He's now endorsing Donald Trump. DeSantis' exit in the race is just 2 days before the New Hampshire primary. Former UN Ambassador Nikki Haley is now the second place candidate. The latest Emerson College polling shows Trump leading New Hampshire with 50%. Haley is at 35%. China's imports of chip-making machines jumped last year. Firms ramped up investments in an attempt to get around U.S.-led efforts to hobble the nation's semiconductor industry. Imports of the machinery used to make computer chips rose 14% in 2023 to almost $40 billion. BlackRock, meanwhile, is looking to sell an office complex in Shanghai. It would be at about a 30% discount to its purchase price. Bloomberg learning that the asset manager wants to speed up the sale of Shanghai towers. Other institutional investors have been offloading offices as a weak economy and oversupply weigh on the Chinese commercial property sector. And that is your Bloomberg Brief. John.
Danny, thank you. Up next on the program, stocks at all-time highs.
If the Fed is not cutting rates because the economy remains strong, I think the U.S. equity market will be pretty much fine with that. If the Fed is cutting rates because the economy is very weak, well, that's a whole other story.
That's next on the program. You're watching Bloomberg Surveillance live from New York City this morning. Good morning.
The 2024 nominating contests are here, and the candidates are making their cases to New Hampshire voters ahead of the primary.
And we're off to New Hampshire.
Bloomberg is live on the ground, bringing you the fastest news,
Trump is leading by a long shot.
insightful interviews,
These candidates are trying to target independent voters.
and the most informative analysis about what it all means for November's presidential election.
What is your path to the nomination?
Coverage continues today, only on Bloomberg.
Live from New York City this morning. Good morning. The price action looks like this on the S&P 500, closing Friday at all-time highs. We had some weight to that rally, up by 1/3 on the S&P. On the surveillance this morning, equities at record highs.
If the Fed is not cutting rates because the economy remains strong, I think the U.S. equity market will be pretty much fine with that. If the Fed is cutting rates because the economy is very weak, well, that's a whole other story. At the end of the day, if the economy delivers, earnings deliver, markets can move a bit higher.
The market's already charging towards Wall Street's year-end targets. Oppenheimer's John Stolfus, the most bullish on the street, calling for 5,200 by year-end. Lisa, that's just 260 points from where the S&P closed on Friday.
All right, you give me a bull, I'll give you a bear. Mike Wilson, over the weekend, he was talking about why he doesn't have the same kind of conviction. He talked about sort of the fiction of the broadening out. He wrote, so far in 2024, the laggards of 2023 are back to lagging, and the winners are back to winning, NVIDIA. When in doubt, it pays to go with the highest probability winner. In this case, it's high-quality growth, really pushing back against this idea that the equal weight is going to somehow gain precedence, that it's all about AI and some of these names that continue to deliver some of the earnings.
The grind hard continues. With us around the table, Stuart Kaiser, head of US trading strategy over at Citi, alongside the brilliant Bob Diamond. Let's get straight into it, Stu. Good news is good news. You've talked about this for a long time. Is the news still good?
Yeah, I think the news is still good. I think the bar's a little bit higher, this year than it was last. If we were sitting here in, January 2023, it'd be a much different discussion in terms of where expectations were. So, yeah, the data's coming in good. I think there's a few more blemishes on the data probably than we've seen in the last few months, and that's gotten people, a little bit cautious about it. But, I generally agree with that view, which is 2023 is the perfect test case for that logic, right? Which is you had, call it 100 basis points of cuts priced into the back half of 23. Data came in really strong, and those cuts got priced out. Equities did just fine. So I think that's your playbook, but the bar is higher than it was last year.
What do you make of Mike Wilson's pushback on this broadening out in the rally, this idea that equal weight can outperform, that some of the beaten up stocks can start to shine again? Do you buy into that?
Yeah, we do. We do like S&P equal weight. It's a little early in the year, I think, to call the end to a trade. And look, we haven't started earnings either. I mean, the view on broadening out from us is an earnings story. It's not necessarily a price action story. And the idea is you have broader earnings, and that allows broader participation in the markets. We've just kicked off earnings season, so I think we want to get through earnings before we're willing to kind of pull the plug on that one. But yeah, we do believe in the broadening out story.
And this is something that's going to be key as people wonder, when is Goldilocks not Goldilocks? We were talking about Max Kettner earlier this morning. Not buying it, saying things had run too fast. You point out that a notable slowing in U.S. labor data is the trigger for you. What does that mean? What's the trigger?
I mean, look, it's payrolls, it's claims, it's credit card spending. Those are the three things we're really focusing on. I think if you were to think like soft landing, hard landing, your soft landing is payroll stay positive, unemployment stays below, let's say, 4.5. A harder landing is you're printing negative payrolls, which I think would be incredibly negative for markets, and you get that unemployment rate above 4.5. So as a quick and dirty, those are levels we're looking at. Frankly, though, I think if we start printing sub 100K jobs, the market's going to, have to obviously increase the probability of that downside tail, and it's going to start to trade that way.
Bob, how frustrating is this story for you? Trying to work out if good news is actually good news.
Well, you phrased it perfectly, and Stuart, I think this fits exactly what you're saying, is if we go back a year from today, I'll have these numbers not exact, I'm sure, but Fed funds are about 4%. And every analyst coming on here is saying we're going to have a recession. And actually, rates went up another 150 basis points, and the economy is stronger. Now we get to this year, and every analyst is saying we're going to have cut after cut after cut. And I just, I think we're back to that same position, which is, I think the consensus has got it wrong going into the first half of this year. I think expecting multiple interest rate cuts in the first half, when our view, similar to Stewart's, is the economy has some momentum. We're looking at continued growth this year, and if we get an economy in the first half of the year greater than 1%, which is the consensus, and the Fed has cut rates and goosed that a bit, I think they're going to be in a difficult position. So I just don't think they're going to do it.
Stuart?
Yeah, I think that's right. I mean, the idea that they're going to cut in March obviously is starting to get priced out a little bit. I think our view on this would generally be the market is taking lead from the Fed. The Fed's telling you they're going to cut, not hike next, and they're pricing probabilistic outcome into this. Just because 6 cuts are priced, it doesn't mean the market necessarily expects 6. The market might expect 2 with what if we have to get 8? Because the economy is weakening significantly. So I think the amount of cuts priced in, it does look a little bit too aggressive, but it's the market saying you're done hiking, so the next move is a cut, and now we're just sort of probability adjusting how many cuts you're going to have to do and when. And the market's going to have to digest that if it comes out.
We were just talking with Bob about all the regional banks that he's going to buy, and I'm curious, from your vantage point, if you're leaning into this idea that a lot of some of the beaten-up stocks, including regionals, can really shine this year.
Look, if I think all the way back to last March, our view on regionals was until private capital invest in these things without a government backstop, we're going to remain pretty cautious. So if he's the private capital and he's putting money in without a government backstop, then I'm all in. I would say, look, we do believe in the broadening out. Regionals and small cap are, obviously you're going all the way to the edge on those ones. I think our view on regionals would be if you get insurance cuts, regionals are going to absolutely rip, right? Because that means you've got strong growth, which the regionals want and need, and you're getting kind of relief on the rate side. So if you kind of thread that needle, I think regionals play right into that. We're a little more cautious than that. We're staying with equal weight S&P right now, and we've honestly had this pushback in conversation with clients. Why aren't you going all the way down to small cap? And look, small cap has a little more of that recession cyclical risk, a little more credit exposure, and a little more rates risk. And we feel like there's a big enough opportunity in the equal weight that you don't need to take that additional step. But look, if we get insurance cuts, regionals are really going to move, I think.
I do have to say, Bob, you've been really behind some pretty bold calls. Also, EU banks over U.S. banks, which has been basically sacrilege to even say. Why this year is finally the trade going to make sense?
Well, I think the way I'd say it, Lisa, apropos of what you said, is since 2008, when the U.S. had a TARP program, and Europe and the UK decided that biblical justice to destroy the banks was their mode, the U.S. banks have just ripped, and the European banks have really struggled. And I think for the first time, if I could say it differently, I'm less bearish on European banks relative to the U.S. banks for the first time. But Lisa, if you look at UBS and Santander, 2 banks as an example, and I'm not saying across the industry, they have return on equity or return on tangible equity above 15%. They're looking a lot more like U.S. banks. They have very strong leadership. They have very strong wealth platforms. They have investment banks that are quite profitable, not trying to be U.S. bulge bracket investment banks, but very similar to the way we built it at Barclays with Barclays Capital. So I think if you look at UBS and Santander, they're going to perform quite well relative to the U.S. banks. Part of that is the valuation spread. Part of it is they're really performing a lot more like U.S. banks. And Stuart, you will recognize this, I think. Rates are going to stay higher longer in Europe than the U.S. because the U.S. economy we're pretty positive on. We don't have that feeling on Europe. But I would say, secondly, the European banks capture that interest rate differential at a better level than the U.S. banks for all kinds of structural reasons. So I'm very much less bearish.
Interesting. Hey, Stuart, got to thank you. It's good to see you, buddy. As always, Stuart Kaiser there of Citi, alongside Bob Diamond. Bob Diamond sticking with us. Coming up on this program, more with the CEO of Atlas Merchants Capital from New York City this morning. Good morning. 2 weeks of gains coming into Monday, 2 days of gains on the S&P 500, closing at all-time highs in Friday's session. Your equity market right now positive by 0.4%. On the Nasdaq 100, up by 0.75%. The Russell, the small caps participating as well, up by about 0.6 here. Lisa, as we turn our attention towards big cap tech over the next couple of weeks.
So can the broadening out continue? And this to me is really going to be key. As people talk about where the profits are going to come from, if you take a look at the profitability of the Mag 7, it is shocking. They're expecting something like 40% increase in profits year over year. It's something insane. So can they continue to lead even as everything else lags behind?
That move in the equity market happening, though, even with these levels achieved in the bond market, the 2-year, the 10-year, the 30-year. We had last week on a 2-year a 24 basis point move higher. On the 10-year, up by 18. This morning, down just by about 3 on a 10-year to 4.09%. But equity performance was decent in the face of a Treasury market sell-off off the back of pretty solid data out of America last week, Bramo.
That's what everyone keeps saying. It matters why rates are going up. If they're going up because things look very good and it's a controlled kind of increase, it's not whipping around by 20 basis points every day or a couple hours, then a lot of people can lean into risk. And we keep hearing this, but there's got to be a break point, right? Where suddenly people have to reprice some of the valuations if yields get materially higher than where they are now.
That's the bond market. Let's just finish on foreign exchange and take a sneak peek of what's happening in FX with the euro against the dollar. Unchanged at 108.98. I think we could just call that 109, Bramo.
So boring.
We've joked about how many times we've heard from Christine Lagarde, the ECB president. Don't just want to talk about the monetary policy. The pushback we saw politically from a central bank president last week against what was happening politically, not in Europe, but over in America potentially over the next 10 months, 11 months.
Talking about how it's going to be really negative for the euro region if Donald Trump becomes the U.S. president again. There is this question of how much this is a policy issue that has to do with investing in Europe and right-sizing some of the technological investments, et cetera. But it does raise a question, right? How she's going to frame this in her press conference. Inevitably, someone's going to ask her, aside from rate cuts, what are you looking at, and how do you respond to potential policy uncertainty over in the U.S.?
She's going to push the politics to one side and say this is about monetary policy today. Can she get away with that on Thursday?
That's what I'm wondering.
I think it's going to be very difficult. I want to go back to how we started our week in Davos, Switzerland at the World Economic Forum. We started by talking about how broken the European model was, the dependence on energy from Russia, on growth from China, on defence from the United States. What was interesting about how the week progressed, we actually saw a lot of leaders come out. The Dutch Prime Minister with us in Davos, Switzerland, say that the former President Donald Trump was right. On NATO, we heard from Emmanuel Macron, the French leader, AMH, who said that we need a sovereign Europe. I would say they're on board with the idea that things are broken. We've got to do something about it.
Yeah, and they're looking internally to the single market. Emmanuel Macron saying they need a sovereign Europe. He said this before, but it seemed like he's ratcheting up that concern if you're looking at potentially Trump back in the White House. And Christine Lagarde, for 1 week, talked about Trump with our Francine Lacroix. When Francine asked about it, she said, I'm going to need some coffee to talk about this. And then she ended her Davos week saying it's time for Europe to go on the attack to prepare for a second Trump term.
She's done it repeatedly over the last week. Let's get to some top stories. Under surveillance this morning, the race for the Republican nomination down to 2. Florida Governor Ron DeSantis ending his campaign for president and endorsing frontrunner Donald Trump. The news coming ahead of tomorrow's New Hampshire primary, with Trump now set to go head-to-head with Nikki Haley, AMH, as the last remaining GOP candidate.
Yeah, and he's pulling ahead in New Hampshire, and this was supposed to be the place that Nikki Haley could potentially break out. This CNN poll yesterday that dropped, he's at 50% in New Hampshire. So the question becomes, if she doesn't come close to that or win New Hampshire, when does Nikki Haley drop out?
When does the market care? Honestly, I mean, I keep wondering how people price this out because, honestly, what we heard from a whole host of executives was we know what we're going to get from Joe Biden. The uncertainty is what we don't know from Donald Trump. But a lot of their trade policies are very similar, actually, ironically. And there's a real question about whether it will be basically the same on policies that are most important to markets.
Bob Diamond, the part of the programme that you were looking forward to the most, politics. You've seen a few of these, haven't you? A few electoral cycles. How different is this one for you?
I think it's not that different when you step back and look at kind of how this election is playing out from an international perspective. So kind of apropos of what you were saying about Christine Lagarde or Macron or, the number of people that you would have seen in Davos last week. I think there is a surprise. It's like, are these really the two candidates? Is there no more change than this? And I think that's been fairly consistent over the last number of elections where it's been, kind of the standard bearers coming out. So I do think there's a disappointment, as not that that's the most important thing, but I do think that there's a negative surprise internationally to these are the two candidates.
How relevant is the political story to your investment decisions? You mentioned Europe versus the United States before the commercial break. How relevant is it now?
You know, it's really interesting. The more you research the impact of elections on the markets, the more you realize there isn't one. And it's not very relevant, Jonathan. And I've been trained in that way by Larry Cantor, our strategist, and other people. As you just go back through the records, what's happening in the election does not have a big impact on the markets. And, you know, what I'd like to believe is the markets are just discounting this before we start to consider it. So from our investment strategy, there's very little impact of what's happening in the election.
That's the domestic story. Let's talk about the international one. The White House warning Houthi attacks on ships in the Red Sea are unlikely to stop immediately and hinting at more action to come. US airstrikes destroying a Houthi anti-ship missile over the weekend in the latest efforts to stop the rebel attacks. President Biden's Deputy National Security Advisor telling ABC it will take time to play out and they'll, quote, have more to say about it soon. Annmarie, can you try and make sense of the communication on this very issue from the administration over the last weekend?
I think you said it best earlier when you said that Biden was saying the quiet part out loud. The Houthis will not stop, but they will continue strikes. But the strikes are going after their material to strike the Red Sea. They're not actually going after leadership or something that could potentially put an end to this. So they're trying to degrade the Houthis' actions without spreading a wider conflict.
All I can say is, I don't know how much this has been priced into a lot of corporate earnings. And I really wonder if we start to hear about that on the earnings calls, this idea that the freedom of the sea is being challenged in a material way, that they're going to have to take longer routes, that's going to pack in some longer times for delivery as well as more gas. Honestly, this to me seems like it should be hitting things much more directly. Mike Wirth of Chevron pointing out that he's surprised that oil prices haven't responded more to this. And going forward, he's expecting, if there is some kind of increased altercation, prices to go back to $100 a barrel.
Torsten Slock of Apollo wrote about this over the weekend, the prospect of goods inflation returning. We'll catch up with Seth Carpenter and Morgan Stanley in the next hour to talk about some of these issues. I want to finish on this story. Macy's rejecting a $5.8 billion takeover from investors, claiming the offer lacked, quote, compelling value. The offer from Arkhouse and Brigade Capital, representing a roughly 19% premium to Macy's last closing price, but the retailer saying the investors failed to address concerns, Lisa, over their ability to finance the transaction.
This to me really highlights, if we get lower rates, do you get more M&A? I'm sort of backing into this. But if you take a step back, it's basically you can make highfalutin proposals. Where are you going to get the capital, especially given where prices are right now? And if you don't have that viability, why should you accept that kind of takeover if it could just basically drag you through the mud in some sort of saga, which we've seen so many times before?
So which one was it? Was it about the availability of the capital or the price they were offering?
I mean, right. At a certain point, it's probably the price, because it always comes down to price. But at the same time, if they're offering a price and they can't come through on it, then it's a wholesale disaster. Whether this is just not wanting to let go and not wanting to just cannibalize the real estate portfolio is another debate.
Bob, can we talk about capital availability? We've seen a lot of issuance in the credit market, backed up by a lot of demand to start 2024. How available is capital currently?
I think, as always, what I'm going to say is what you would expect is for the right idea, there's capital. We go back to the credit markets. I think the expectation, not that there's cuts necessarily, but that the Fed has finished, has created, a real opportunity for the issuance of credit.
Issuance through the roof, Bramo, over the last month or so, last few weeks.
It's been one of the busiest Januaries for more than a decade, I believe, as people try to come back and get their capital up to date. I do wonder whether this is people who have been holding off, who now have certainty that rates are going to be going down and they have certainty of their businesses, or if this is people who have been holding out for as long as they can and now they have to refinance. And I wonder if you get more of that down the line with companies with less secure business models. Do you have a little bit more of a disruption because spreads are actually in, even with all this issuance?
We talked about that phrase last week in Davos, survive until 2025. The hope is that ultimately rates come down and when you need to issue, they'll be lower than they were in the last 12 months, but I guess we'll see.
I just am wondering how many zombies are going to come out of the woodwork. I mean, I know Tom, with his zombie roll-up, There is this question of, okay, there are some companies that were sustained by zero rate policies, and you had 5% high yield bond yields, all in yields. Now you're looking at 10%. Is that viable for a lot of these companies? And the answer is going to be no. It's just that, okay, well, maybe they're not going to be 10% then. Maybe they'll be a lot lower. And I think, survive until 25 has continued to this day.
I do love that phrase, survive until 25. Bob Diamond's going to weigh in on that with Kelsey Barrow of JP Morgan in just a moment. Let's get you some of the headlines from stories elsewhere this morning. Let's cross over to Danny Berger. Morning, Danny.
Good morning, John. The Republican presidential primary is now down to two candidates. Florida Governor Ron DeSantis dropped out on Sunday, leaving Nikki Haley and Donald Trump to battle it out in New Hampshire tomorrow. DeSantis has endorsed the former president, who is the current frontrunner. Macy's is walking away from a $5.8 billion takeover bid. Investors Ark House Management and Brigade Capital Management had offered a deal that represents about a 19% premium to the close on Friday. Macy's board, though, declined to provide due diligence to Ark House and Brigade. Ark House says it is, quote, highly motivated to make a deal. And shares of Boeing drop in the pre-market trade as the FAA tells airlines to check parts of another 737 model produced by the manufacturer. The regulator recommended inspecting the same type of door plugs that failed on an Alaska Air flight earlier in the month. Boeing shares have fallen almost 14% since the mid-air blowout of a 737 MAX 9 door. And that's your Bloomberg Brief. John.
Danny, thank you. Up next on the program, the Fed remains patient.
When the time is right to begin lowering rates, I believe it can and should be lowered methodically and carefully.
That's next on the program. You're watching Bloomberg Surveillance. Live from New York City this morning. Good morning to you all. Here's the price action on the S&P 500. All-time highs at the close on Friday. We add some weight to it this morning. This Monday morning positive by 0.4%. Under surveillance this morning, the Fed remains patient.
When the time is right to begin lowering rates, I believe it can and should be lowered methodically and carefully. With economic activity and labor markets in good shape and inflation coming down gradually to 2%, I see no reason to move as quickly or cut as rapidly as in the past.
That's the latest from Fed Governor Christopher Waller speaking to the Brookings Institute last week. Lisa, I did not hear the month of March from any Fed official over the last week.
They all tried to push back, and this whole idea that this time is going to look a little bit different just because inflation is structurally higher and there's no need to cut rates dramatically. Still, you're seeing buy the dip out there, and the dip being the bond market selling off. And we saw that from Matt Hornbach, who wrote in a paper over the weekend. He's the head of macro strategy at Morgan Stanley. This is the dip we have been looking to buy. With less fiscal support and much colder weather, we see downside risks to U.S. activity delivered in February. So blame the weather, blame the fact that you have perhaps less fiscal support, but maybe the data is going to turn, according to him.
Kelsey Barrow with us around the table, fixed income portfolio manager at JP Morgan Asset Management. Kelsey, good morning.
Good morning.
The perceived gap between the Federal Reserve and markets, are we closing that gap with the market coming up to the Fed, or do you see the Fed coming down to the market sometime soon?
So we are closing that gap, but I would say I don't really view the gap as that wide, right? So Waller was maybe pushing back on the timing, but I think what he was mainly pushing back on is this idea of very aggressive cuts. So if you remember on the way up, we were hiking 75 basis points a clip. I think what he was trying to push back on is on the way down, this is going to be much more gradual and methodical. Don't expect us to be cutting as fast as we were hiking because we're not in an emergency environment. We're in an environment where the labor market is still healthy, inflation is coming down. That justifies cuts. Pretty much everyone on the FOMC, if you look back at the dot plot, only two showed the Fed funds rate unchanged by the end of the year. So everyone's in consensus there. It's really about the speed. So I actually don't see a huge gap between the market and what the Fed ultimately wants to do.
So 6 rate cuts this year you think is plausible with the rhetoric that we've heard from the Fed?
It is still plausible. I mean, there's only a certain number of meetings in the year. So as you push push back on March. That is one less meeting that can be achieved. But I look at the path of the Fed funds rate, not just over the calendar year of 2024, because I think we get a little obsessed with these calendar years. And I look at where is the Fed funds rate troughing at? It's troughing at 3.3%. That's the bottom in which the market is pricing the Fed funds rate to get to. That's a reasonable easing cycle. It's not an overly aggressive easing cycle. It's an easing cycle I think is still consistent with soft landing pricing.
What I'm struggling with is there is an inconsistency with this idea of rate cuts, aggressive or not, gradual, sure, but rate cuts that deep with an economy that's moving as robustly as we keep hearing. Is that dissonant for you, or does that make sense?
So I think that the economy does need to moderate for the Fed to continue to have confidence that inflation is going to be sustainably at 2%. So, this isn't supposed to be a situation where inflation touches down to 2% and takes back off. This needs to be an extended stay at 2%. And the way that they get confidence in that is if the labor market cools enough. But I do think under the surface, the labor market is cooling. So, for instance, if you take a look at private payrolls and you strip out government hiring, which tends to accelerate in the late cycle, which is something we've seen time and time again, and you take out education and healthcare, we're actually grinding down to nearly zero on private payrolls growth when you exclude those categories. So I think things are softening, but we do need to be cognizant of that. The fact that the Fed is considering rate cuts does introduce a new tail risk that we weren't thinking about in 2023, which is the reacceleration risk. And we are cognizant of that.
Jobless claims 187. What are claims doing falling if things are slowing and getting weaker?
Right. Well, there's two different pieces of the labor market puzzle, right? You have layoffs, which are still low, but you have hiring, which is slowing. And I think that makes sense. Just think about companies, right? How do they behave when demand is moderating? They don't immediately fire everyone. They first start by looking to cut back people's hours, which you have seen. And then also maybe they don't need to raise wages as much as they did. And then firing, they are going to be more hesitant to do that, particularly based on how hard it was to find those people in the first place. So yes, there's a little bit of dissonance there. There are a lot of data points that are kind of sporadic right now, which I think is indicative of kind of an inflection point. I think you do see more data pointing in different directions when you're at a turning point in the economy. So baseline, I think you still need the economy to cool to get the Fed to cut, but that is our expectation.
Well, this is a question for business operators. The decision that they've got to make ultimately to perhaps hoard talent. Do you think this labour market, this cycle that we're starting to see emerge, is going to be different to what we've seen in cycles gone by?
Yeah, I think Kelsey's point, which is that over the last couple of years, I think hiring talent has been more challenging than it has normally been. People aren't going to forget that immediately. So I think I wouldn't have thought hoarding talent would be the way, but I do think cutting talented people would be very, very challenging. I don't think the environment's calling for it yet. Neither does Kelsey, but I do think people will recall that we've been through probably the most challenging market for hiring talent since COVID began that I've seen in my career.
So I'm wondering what you think of what Kelsey was talking about, given the fact that you see only 2 rate cuts this year maximum, and think that the Fed doesn't have the room to cut rates very aggressively. Where do you diverge from what Kelsey is saying?
I think we're both saying the Fed will be data dependent still, and that they haven't made their decision. I think where we would agree, I would say, Kelsey, is that we've seen the peak. I would bring up 2 things in terms of why I'm probably a little bit more cautious, but directionally we're kind of the same. One, while monetary policy has been tight, fiscal policy is getting loose again. We have $2 trillion coming out in spending for infrastructure, and I haven't heard anyone talk about that. So I think that's one thing. And 2, I believe strongly that the Fed has to be very, very conscious of getting ahead of this. If they cut rates once or twice and there's an acceleration in inflation and they have to reverse course, I just think that's the worst position for the Fed. On the other hand, if the economy begins slowing because they haven't cut rates and then they cut because the economy is slowing, it's exactly the plan that they want. So I think they're going to be extremely cautious. The last thing I'd say is if I'm a bit of a historian. I mentioned the work I do with our operating partner, Larry Cantor, earlier. He worked with the Fed for many years. And if you go back through history of the Fed, the bar for reversing course is very, very high. So there's no question there's a pause. There's no question their intention is to not raise rates anymore. But the actual bar for reversal, because of the signal with reversal, is very high. I think they're going to be really cautious. And my sense is it's going to be second half.
There's a lot to unpack there. I want to focus on the fiscal actually for a minute because there are $162 billion of auctions just this week alone. 2-year notes tomorrow, 5-year notes Wednesday, $41 billion of 7-year notes on Thursday. Kelsey, when do people start to care about the deficit again? Are we one bad auction away from sort of this premium baked into valuations?
Well, I don't think this is the week. Maybe famous last words, but I do think that we're in an environment where there is demand that's meeting this supply. It's not just in treasuries. We've had a tremendous few weeks in investment grade credit. For example, I think just to speak to the amount of the way that sentiment has shifted over the last 12 months, you think about the regional banks and the issuance that they've done over the past week. These are banks that wouldn't have been able to issue last spring, and you wouldn't have been able to sell the paper even if you tried. And now they're issuing with a little concession and multiple times oversubscribed on the books. So it's been a really large sentiment shift, and I don't expect that to change anytime soon. But just getting back to this idea of where this risk that the Fed may be more cautious and more gradual. I actually think that that's not a bad environment for fixed income investors, because while we're waiting for them to decide when the first cut is going to come, you can collect that carry. But then in the event that the economy does slow down more, the Fed has more policy space than they've had in a very long time. You think about how much they cut during COVID. They cut 200 basis points because that's the only space they had. They were at 2 3/8. And they had to cut to 0. Now they have a lot of policy space. They have a lot of ammunition to help the economy if things do slow. So risk reward for fixed income investors, really good here.
You talked about the potential of going back to, say, 330 on Fed funds. What are you thinking about the longer end of the curve? Because presumably what I'm hearing from you is investment risk, whether you're looking at T-bills maturing and reinvesting that capital. You don't want to miss out on this move further out the curve. If yields are at, 4% now, you risk them dropping to 3.5%?
Yeah, I think that's reasonable. So typically what happens with the shape of the yield curve is ultimately most of the volatility in the yield curve is going to be driven by the front end. So it's the story over longer periods of time is that as the Fed is cutting rates, you see the curve. As the Fed is hiking rates, you see the curve flattening. As the Fed is cutting rates, you see the curve steepening, right? So we're entering a period where the Fed's on pause. The next move is going to be a cut. Ultimately, in that environment, the curve is going to be steeper. In the very short term, as March is being priced out in terms of the market probability, I think you could actually see a little bit of tactical flattening. But that's very much on the margin. In general, big picture, over cycles, if the Fed is cutting rates, you're seeing the curve steepen.
Are you more bullish right now on treasuries than you are on corporate credit?
That's a tough one, but I would say we're actually feeling very good about corporate credit as well, particularly investment grade and high quality, because again, that risk reward we see is very favorable. The technicals are a big part of that market, and we're seeing quite a lot of demand come in. I think there were a lot of people who were concerned in November and December that they missed the rally. So if you look at how much the U.S. aggregate was up in November and December, it was about 8%, which is absolutely massive. And there were a lot of people asking the question, did they miss it? And I think the point is, any of these backups is really an opportunity for those people to get invested, lock in yields that you really haven't been able to achieve in a high-quality fixed income portfolio in multiple decades.
Kelsey, this was great. Kelsey Barrow there of JP Morgan Asset Management alongside the brilliant Bob Diamond of Atlas Merchant Capital. You heard that one, Bramo. Lock it in. I've heard that so much over the last 6 months.
Yeah, although if you're locking it in right now, we're looking at spreads on investment grade credit that are the lowest going back to February 2022. So I don't know if you've missed it, but the idea of selling it off. I mean, this is such a confusing market. This is not what we normally expect with credit spreads coming in.
What does Steve Major say over at HSBC? And we've talked about this lots. The demand now at 4 is greater than the demand existed when we were at 5.
Yeah,
it's just the way markets work.
Yeah, when something's on sale, you don't
You run
want
away.
it. Yeah, exactly.
Yeah.
When it's really
The
expensive.
price starts climbing.
You just
go towards
all in.
it. No, I know. It's the psychology of things. Bob, it's good to see you. Thank you, sir. Coming up on this programme, Alicia Levine of BNY Mellon, Seth Carpenter of Morgan Stanley. Plus, we'll catch up with Katie Ledines on the latest in Washington, D.C. From New York City this morning. Good morning.
We are very pleased what's happening with automotive. We're now working with virtually every car company.
The innovation from our new products and services, that's really what will drive us forward.
We have better jobs, we have better national security, better economic, and we're ready for a turbulent world.
Travel is doing very well. Entertainment is doing very well. Wellness products are doing very well.
I think you're going to see the banks do really, really well, and they're going to be a wonderful performing asset in 2024.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning. Good morning. For our audience worldwide, this is Bloomberg Surveillance alongside Lisa Abramowicz, together with Annmarie Hordern. I'm Jonathan Ferro. Your equity market at all-time highs on Friday. Your equity market this morning adding some weight to that rally, positive by 0.4%. Lisa said it last week, the difference between doers and thinkers in Davos, Switzerland.
The doers are saying, let's go. Really well, really good. You just heard that in all of the interviews that we did in terms of this optimism. And then you talk to the thinkers and they say, well, what about the Houthis? And what about the Middle East? And what about the election cycle? And what about the potential for some kind of slowdown? And why are you guys so optimistic? And I kind of understand the thinkers, but the doers are giving a very different story out there right now.
The President of the United States hoping the former are right and the latter are wrong.
Yeah, absolutely, because the risks right now are concerning for them, given the fact that when you look at what people care about, it's the economy. And people are actually starting to feel better about it. That's what we saw on Friday. People are starting to feel better about the economy. Inflation is coming down. Is the timeline on their side? But could something like what is going on in the Red Sea upend all of that, especially when it comes to inflation?
We often ask this question. On your dashboard right now, what's your North Star? What's guiding you? Which economic data point? If you wanted to pick one from the last 12 months, it might be jobless claims. Jobless claims dropping last week. Lisa, they stand out to me, not retail sales. Jobless claims back at 187K.
And we talked to the executive of Manpower Group, which is the biggest staffing firm globally, and they're saying the same thing, that people are able to get hired. So if the labor market is good, and we were just talking to Stuart Kaiser, that's his lodestar, then what's exactly going to cause things to turn the other way? The kicker, though, is if that's the case, why should the Fed cut so aggressively, and has that fully been priced into the market?
Stuart's been clear. Good news is good news. And based on the communication we've had from the Federal Reserve in the last week, that's been reinforced by the economic data. Let's get to the price action right now. Positive by 0.4% on the S&P 500. In the bond market, yields just a little bit lower, down about 3 basis points, Lisa. Let's call it 4.1% on a 10-year.
And really, to me, the big test is going to be on Friday. We get core PCE, that key inflation metric that the Fed looks at. If you see it come in as aggressively as some people are expecting, it's supposed to maybe stay in line, then do you get a sort of leaning into this Goldilocks that everyone's been playing into, and it starts to broaden out beyond just NVIDIA, which is up 20%.
And that's the market with a big move on NVIDIA. Coming up on this programme, about 90 minutes away until the opening bell, with stocks sitting at all-time highs. We talked lots about the financials in the last couple of weeks. Wall Street is done. We'll talk more about big tech in the weeks to come. Microsoft next week, Apple the following week in early February. Then we've got to talk about the president. President Biden getting his wish, consumer confidence beginning to bounce. Did Nikki Haley, Annmarie, get her wish over the weekend?
It really depends on where this 5% that DeSantis was polling in New Hampshire go. Do they go to Trump or they go to Nikki Haley? But I think he did her a favor by dropping out before, because at least it gives her that opportunity to get some of those DeSantis votes, given the fact that if you look at the polling over the weekend, it is Trump's to lose. He's at 50% now to her 30-something.
I'm sick of talking about this election and it's just starting. And we heard from Bob Diamond this idea that
it's January.
It's January, but this is what he said too. He said that there's a little bit of disappointment just in general that these are the two candidates, and that maybe that's the risk that people are kind of leaning into right now.
You've heard a lot of people say it. Could we have done better than this?
I know.
You see it in the polls. You've seen it in the polls repeatedly
It's the
for
election.
months now.
It's the election Americans don't want. They don't want this rematch, but it's the election they're going to get.
Which begs the question: what's turnout going to be like at this election, given that there is basically no enthusiasm to end up with these two candidates?
Especially in the groups that the Biden administration is going after. The youth that came out for him, will they come out for him this time around? That's going to be a huge issue for them in places like Wisconsin and Michigan.
Katie Lyons down in Washington joining us in just a moment. We need to talk about this as well. Rejecting a $5.8 billion takeover. Macy's, Bramo, is pushing back and pushing back hard.
You raised this question. Is it because of valuation, it's a 19% premium, or is it because of questions around financing? The issue with Macy's is it has a lot of hope that it can rejigger itself as some sort of juggernaut of the shopping retail experience. But other people are saying it's just a real estate shop, that essentially they just need to sell their businesses. So at what point do they start to have some real questions about their potential valuation versus their existing valuation right now?
Is it about the valuation or about the availability of capital? We talked about that briefly.
Yeah.
Sounds like the latter, not the former.
Well, I was about to say, I have a feeling I know where you stand on that. Like, isn't it about valuation?
No,
though?
I just mean,
Come on.
I mean, why would you bring up the availability of the capital if you were unhappy with the price? You just wouldn't talk about it, would you?
Okay, right. Although if you want to discredit them in a more significant way while
Sure.
also continuing to open the door to other bids. It's like we're not for sale. It's just that we want a better sale from someone who's a little bit better.
And might have the actual money to
Pay
follow
for it.
through. Sure. OK. I think we agree.
I think
We're
we
clear on
do,
that.
too.
All right.
Carry
Let's
on.
begin with our top story. Stocks sitting at all-time highs, but Alicia Levine of BNY Mellon Wealth Management seeing a bump in the road, writing this. The equity market struggles in the first half and gets stronger into year-end. This is consistent with the business cycle of possible slowdown in the first half and the typical cycle in an election year where it's hard to have a recession. Alicia Levine joins us now for more. Alicia, good morning.
Good morning.
Got to get to the election piece of that. Why is it hard to have a recession in an election year?
We had news in the last 3 days that tells you there's going to be another fiscal bill, right? So the administration in a re-election year has tools in its tool case to really steady the economy if there's any slowdown. And so what Biden's going after the consumer, the tax credit to consumers, the financial modeling and gap in taking some of those tax cuts from Trump that were going to expire, bringing it back, 100% expensing. So what we see is $100 billion coming out of the gate in fiscal that's going to steady the corporate sector and the household sector. And then 2024 is the year that $2 trillion of stimulus that was passed in the last couple of years for the IRA, the CHIPS Act, and the infrastructure bill is going to come on board. So you're starting to see the money pumping from Washington again, even though we thought it was all over, and it's not all over.
So this really begs the question, just on the bond side of things, isn't this going to blow out the bond market if fiscal support actually accelerates, not declines, as so many people are expecting?
So that's a really interesting question. I think what's going to also happen this year is that you're going to have better tax receipts because of the stock market and because of corporate profitability last year. And so come April and come the quarterly tax season, you're going to see greater receipts than last year, okay, which is going to steady the deficit. And once that happens, that will steady the bond market. So that risk, yes, overall, like why are we doing more fiscal? The fiscal's already been spent, right? It's already been spent, but we're getting more in tax receipts. And so that's going to help steady the issuance.
We heard a little bit about this from Bob Diamond in the last hour, this concern about fiscal deficits. He's saying that it's not going to be an issue for the market this year, but will be next year. At what point people start to get actually concerned about the U.S. financial health?
So people will start getting concerned about it after the election year. Nobody, neither the challenger or the incumbent cares about the fiscal health of the U.S. while they're running, right? Because in the end, politicians were put on earth to give away things and not take them away. And that hasn't happened in a really long time. If you go back to the end of the end of the Berlin Wall, right? Go back over the last 30 years or so. Every administration, whether Democrat or Republican, cut taxes, okay, and did fiscal spend. So the opposite, which you would expect to happen, is really painful. Nobody remembers what it's like to have austerity, and neither of them is running on it. So if it's going to happen, it's going to have to be the bond market saying it. It's going to have to be Congress saying it. It's going to be the other side of the election. So 2025, you could have the conversation.
The bond market whispered it in October, I guess, and then took it back pretty quickly for a month or something like that. Alicia, we're talking exclusively about the United States.
Correct.
Europe's struggling. China, the data out of China is still pretty dreadful. Are we basically firing on one engine at the moment in the global economy?
It looks that way, and it looks like it could be that way because what's going on in the Red Sea is actually more of a risk to Europe than it is to the U.S. So oil and gas prices and just the proximity creates an inflation risk for Europe in a way that just doesn't here. We're just not as levered to that problem. And then China, as we know, simply can't get out of its own way. I mean, it's really the third year that the market is terrible. It's the sentiment is so bad. I would have to expect that there's an opportunity somewhere, but we pulled our clients out of China because we just think it's not a place that you can, as a fiduciary, that you can put client capital.
You think it's uninvestable?
Essentially.
For the time being, what would you look to change that ultimately?
I think the corporate governance. I mean, in the end, you don't own shares of corporate China. You don't own it. In the end, the political party is sitting at the top of the corporate structure of every large company and small company in China. Very hard to invest that way. So, if you're a fiduciary, as we are, that's just not something that we can model or that we can risk out.
Every time
but
this
we
comes
like
up,
emerging markets. I just wouldn't be.
Can you strip out China from EM? What does that even look like?
You could. I mean, in the end, if you look at who gains if China fails, well, you've got Vietnam and you've got Mexico and you have India. So you can, and in fact, China's loss are those countries' gains.
Although at this point, are you betting on some sort of ongoing economic malaise that could have some sort of trigger, or just you can't invest there because you don't know what the rules are going to be? Is there a distinction?
Yeah, so it's a good question. Am I worried about the fundamentals in China, or am I worried about that as an investor class we're not protected there? It's both, but the fundamentals don't look great. And let me just say one thing.
Sure.
When you think about GDP growth in China since the WTO, right, it was extraordinary. Think about compounding GDP growth in China, and yet you made zero investing in China. So when China slows down, why do you think you're going to make money in China? If you couldn't make money in China when it was growing 8, 7, 6%, you're not going to make money in China if it was growing 4 and 5%. It's actually extraordinary looking at the charts. You've made no money in China since the WTO.
No, we're totally sport in the United States. We're conditioned to believe that stocks only do one thing, they go up and to the right. Everywhere else, lost decades. Look across the board, Japan, Hong Kong. China, the experience in China has been absolutely dreadful in equity markets.
Although it hasn't necessarily come because of growth. It's come as a result of certain policies and a lack of predictability. And that's the unique feature. At this point, though, how do you game out the global economic consequence of a slower China that doesn't have the levers to pull to attract that foreign investment in the same kind of way? I don't really know the answer.
Alicia, this is great. You're going to stick with us, I'm pleased to say. Alicia Levine of BNY Mellon. Let's get you some of the headlines from stories elsewhere this morning. We can say good morning to Danny Berger. Morning, Danny.
Good morning, John. Florida Governor Ron DeSantis has dropped out of the presidential race and has endorsed the former president. The GOP nomination is now down to 2 candidates, with Donald Trump front-running Nikki Haley. Voters head to the polls tomorrow for the New Hampshire primary. ADM is placing its CFO on leave and cutting its earning outlook. That's pending an investigation into the agricultural trading giant's accounting practices. The probe is in a response to a voluntary document request by the SEC. Shares of ADM are dropping in the pre-market trade. And shares of Boeing are extending declines in the pre-market trade as the FAA tells airlines to check parts of another 737 model. The regulator recommended inspecting the door plugs that failed on an Alaskan Airlines flight earlier this month. Boeing shares have fallen almost 14% since the mid-air blowout of a 737 MAX 9 door. And that's your Bloomberg Brief. John.
Danny, thanks for the update. Appreciate it. Up next on the program, the GOP field is narrowing.
I am today suspending my campaign. I'm proud to have delivered on 100% of my promises, and I will not stop now.
Live from New York City, that conversation is coming up next from New York this morning. Good morning. You're watching Bloomberg Surveillance.
The 2024 nominating contests are here, and the candidates are making their cases to New Hampshire voters ahead of the primary.
And we're off to New Hampshire.
Bloomberg is live in the ground, bringing you the fastest news,
Trump is leading by a long shot,
insightful interviews,
These candidates are trying to target independent voters,
and the most informative analysis about what it all means for November's presidential election.
What is your path to the nomination?
Coverage continues today, only on Bloomberg.
Live from New York City, a little more than 60 minutes until the opening bell in New York on Wall Street. Equity futures shaping up as follows on the S&P 500. Adding some weight to the all-time high that we saw at the close on Friday. We're up by 0.4% on the S&P. Under surveillance this morning, DeSantis is out. The GOP field is narrowing.
I am today suspending my campaign. I'm proud to have delivered on 100% of my promises, and I will not stop now. It's clear to me that a majority of Republican primary voters want to give Donald Trump another chance. I signed a pledge to support the Republican nominee, and I will honor that pledge. He has my endorsement because we can't go back to the old Republican guard of yesteryear.
Ron DeSantis dropping out of the presidential race, throwing his support behind Donald Trump, just days ahead of the New Hampshire primary, where the latest polls show the former president widening his lead over Nikki Haley. Trump welcoming the endorsement from the Florida governor. Annmarie saying this: I look forward to working with Ron. That is a change of tone in the last 24 hours.
Oh, not just that in a change of tone. He also said he's going to be retiring his nicknames for the governor of Florida, especially since he's been calling him Ron DeSanctimonious. He says that's over now that he's come out and endorsed me. Jonathan, a scathing opinion piece this morning from Political. They weigh in saying, quote, perhaps Trump's vast lead could not be overcome, and this was the wrong cycle for DeSantis to run. Perhaps for someone so uncomfortable with people.
That's brutal.
This was the wrong decade or century. Still, that's no excuse for misspending over $130 million and running the worst presidential campaign in history. And I got to be honest with you, read the whole piece. This is actually some of the least scathing bit of this piece from Politico, just absolutely dumping on DeSantis' campaign and how it was run.
It didn't start well, did it?
No, this idea of failure to launch. I mean, talking about this idea with this Twitter or X
They thought it was going to be edgy.
They thought it was going to be edgy. It just failed. And then he was talking about how they broke the internet. And they said, no, it just failed. And that was sort of a question. And it sort of highlighted the underpinnings of the campaign. I will just say at this point, big question about where that support goes. Does that help Nikki Haley? This is what Nikki Haley's wanted all along. Has it come too late? Is it enough?
Let's talk about that right now with Bloomberg's Kelly Lyons, live from New Hampshire. Kelly, walk us through how different New Hampshire will be versus Iowa just a week ago.
Well, in some ways, John, New Hampshire won't be drastically different for DeSantis no longer being in the race. He was polling in low single digits here, roughly 6% in the latest polls that we had been seeing. So his departure may help perhaps Trump on the margin, but still it largely is the two-person race that Nikki Haley was painting it a picture of as we emerge from Iowa. But in terms of actually how New Hampshire is different than Iowa, demographics are a huge part of it. Iowa obviously has a strong conservative base, a lot of evangelicals in the first-in-the-nation caucus state. Those lended their support more to Trump. Nikki Haley really struggled to get those voters. What she's going to try to do here in New Hampshire is capture all of the independents, more moderate Republicans that she is trying to cater to. That's what New Hampshire is known for. But at this point, polling is suggesting that that just might not be enough. In the latest Suffolk University Boston Globe poll that came out this morning, she is behind Trump by 19 points. And the enthusiasm gap between these two candidates is still very wide, just as it was in Iowa.
And Kayleigh, she has the support of the governor there, who's very popular for a Republican in this state. I think about what his father used to say, which is Iowa picks corn, New Hampshire picks president. But it looks like when you look at the polls, he backed the wrong person to be the next potential president.
Yeah, Governor Chris Sununu obviously is very popular in New Hampshire, and he is still standing by Nikki Haley as a candidate. He is not a Trump Republican, even though he has said he would support him if Trump ultimately becomes the Republican nominee. He does not think that he holds Republican values, and he thinks Nikki Haley still could have a chance. That said, he and even Nikki Haley herself are starting to set the bar lower for her as we actually approach primary day tomorrow. He's suggesting that a strong second place showing, something better than Iowa, will be enough momentum to carry her forward in this race towards South Carolina, for example, which, yes, is her home state where she served as governor, yet she is still polling even farther below him there than she is here in New Hampshire. But he stressed to Joe Matthew and I when we spoke to him yesterday that New Hampshire is not a must-win state. None of the early states really are. It's until Super Tuesday that she's going to have to start winning in some of those states come early March. But he also talked about the economy. I asked him, we have a stock market at the record high. We have unemployment still below 4%. The labor market's hanging in there. Inflation is down. Is this not something that any future president, perhaps a future President Haley, would want to emulate when he was criticizing the Biden administration? And this is what he told me in response.
Let's look at national credit card debt. Let's look at what everybody owes, right? The spending that has gone on, not just with the government, but now with personal spending, and the fact that inflation is crushing folks. And this whole idea that the Fed is coming out and going to lower rates, I'm telling you, the piper has to be paid at some point. I think we are in store for an economic downturn.
And we know, just as in Iowa, the economy is top of mind for voters, but so too is immigration, the issue of the border. And Nikki Haley essentially is suggesting that she will be able to do what President Trump could not during his first term, which is actually secure the border, do things like finish the border wall. The governor told us that the difference between Haley and Trump isn't necessarily on policy, but the ability to execute on that policy.
So, Kaylee, the big question going into tomorrow is, where does the DeSantis votes go, though? Does she pick any of them up? But I guess you have to think it's only 5%, so it's still a long shot for her if you look at the polls.
Yeah, exactly. He just wasn't a significant factor in New Hampshire, nor was Vivek Ramaswamy, who also dropped out of the race and endorsed Trump after Iowa. It does seem, though, that probably by and large more DeSantis votes would go to the former president than they would to Nikki Haley. But the gap that she is currently facing, at least if polling is correct, is just so large that even those marginal DeSantis votes aren't necessarily going to make a difference. So it really becomes a question of what exactly Haley and the campaign define a strong second as. If you are coming in double digits below the former president in New Hampshire, again, a state with those moderate and independent voters that you are trying to attract, is that really a mandate to continue the campaign forward another 4 weeks to South Carolina? That primary, of course, is on February 24th. Yes, the Haley campaign has resources. She is backed by Americans for Prosperity Action, the Koch super PAC. And yet, as we've seen with Ron DeSantis, it feels that a lot more individuals, including those who are also running against Trump in this campaign, are just falling in line behind him. And I was at an event last night with many Republican strategists who have been involved in these primary campaigns in past cycles, all of them kind of just stressing that there is an inevitability here that Trump is going to be the nominee.
Kaylee, great update. Appreciate it. Kenny Lyons there in New Hampshire. More from Kenny through the next 24 hours on the ground in New Hampshire. With us around a table here in New York, Alicia Levine of BNY Mellon. Alicia, let's finish on the politics if we can. We talked about this last week on this programme, that candidate Trump, President Trump, comes with a lot of volatility. But this market, at one point, in late 2016, overnight when the results were coming through, started to focus on the policy and not the man. When you think about the policy of what could come, when do we start focusing on that in the next 9, 10, 11 months?
Look, usually it happens around August. August, September is when you start seeing a very clear bifurcation in different sectors over the polling of who could win. So that's really when you're going to see it. And like healthcare, for instance, is the sector that you'd see it most. So if Biden looks like he can pull it out, you'd expect weaker healthcare. If it's Trump, less of an issue for healthcare. I mean, still not the favorite. You know, the pharmaceutical industry is not the favorite of either party, but still worse under the Democrats. Tech probably does better under the Republicans, because I would bet the FTC challenge goes away also. So, you know, the Republicans just aren't really good at regulating, right? Their hearts aren't in it. And so I would just say there's less of a regulatory problem for large cap tech under Republicans than Democrats. And I'd also say energy is pretty clear also. I mean, look how poorly the energy sector did under the first Trump administration compared to every other sector. So,
at a certain point, you travel all around the world talking to clients, international clients. What are they asking about how you're going to respond to the presidential election? Do they care about it? Does it come up in conversations?
They seem to care more than we do. Because what investors in America understand is that investing based on your politics is a loser, right? Right. If you look out 1, 2, 3, 5 years, whatever your political stance, who's ever in office, the stock market, as you said, John, is up and to the right.
Yeah.
Okay, 6 out of 7 years. So the Europeans worry more, they condemn us more, but ultimately the American investor base knows that this is the place where capital is treated the best, and we are here to invest, and that's what we do. And we're doers and not thinkers. We think, but then we do.
Your point to me.
The Inflation Reduction Act, though, wasn't welcomed in Europe, and I had Europeans say to me, it's just better bedside manner, but a lot of the policies were the same, whether it's Trump or Biden.
Here, I think is what a lot of people said about capital being treated better here in the United States. Alicia, that was great. Appreciate it.
Thank you.
It's good to see you. Alicia Levine
you.
of BNY Mellon Wealth Management. Mark Dow. I always remember what Mark Dow says. I repeat it all the time. He said back in 2016, the challenge for investors, divorce your political bias from your economic analysis. And for the next 4 years, everyone struggled to do it. Seth Carpenter at Morgan Stanley is going to join us next. Live from New York City, this is Bloomberg. "60 minutes away from the opening bell, equity futures look like this on the S&P 500, pushing higher once again on a 2-day winning streak as we close out Friday. 2 weeks of gains at record highs. We had some more weight to those all-time highs, up by 0.4% on the S&P, on the Nasdaq up by 0.7%, up by 0.75% on a Russell. The small caps pushing higher as well. In the bond market, 2-year, 10-year, 30-year, 2-year up by something like 24 basis points last week. Your yield, 437.62, down by not even a basis point. The data supportive of higher yields. Just go through it all. Clean sweep, Lisa. Retail sales, jobless claims, consumer confidence right across the board looking strong.
And it seemed to really edify this idea of a soft landing, because not only was consumer confidence the strongest going back more than a year, but you also saw the expectation for inflation coming down. So there's this idea the Fed can land this, and it's great for risk assets.
Want to finish on foreign exchange. The euro right now just south of 109 at 108.88. That currency pair negative by about 0.1%. Amazing to hear from Alicia Levine of BNY Mellon. And if you missed it, I'll try and paraphrase. Basically, in Europe, they're more concerned about the politics in the United States than investors in the United States should be, because capital, if you look at worldwide, capital is treated better in America than anywhere else. And for that matter, she is bullish US equities versus everything else.
It was funny because she was talking about all of her conversations internationally, and she just kept saying, they're more worried than we are. We're looking at it and understanding that all the noise can really come down to markets go up, and that's what they're betting on.
We heard this again and again in Davos, Switzerland. Political risks and rate cut expectations taking centre stage at the World Economic Forum. Investors, CEOs and government officials joined us to weigh in. Live from Davos, Switzerland for our audience worldwide. Good afternoon. Good afternoon.
Everyone's just focusing on Donald Trump. Everyone is talking about it behind the scenes. No one really wants to talk about it when you get them.
It's the elephant in the room, or the Swiss Alps.
Everything changes if Trump wins, in mostly for bad ways.
If Trump wins New Hampshire, is that a time when you're going to say, OK, I'm ready to endorse him?
I think it depends on kind of what happens, you know, how big a win it is. If that happens, if somebody else wins, what happens. I mean, I wouldn't want to speculate on that.
I will campaign for President Biden. I will certainly, because the stakes could not be higher for our country, for the world.
The economy is the #1 issue, John, when it comes to American voters.
Our camp is that we still see a recession coming, and although our base case is a mild recession.
Everyone's expecting the Fed to cut rates, possibly, if you believe the market, 6 times this year.
The 6 rate cuts, that's a pipe dream if we have a soft landing.
The market is now calling for a 175 basis point cut by the Fed. Really? How about this? No way. No way at all.
I think one of the risks is that the market is pricing in some aggressive rate cuts. The real risk is probably geopolitical.
Early October, your world changed. Can you tell me what it's like now, what's changed for you as a governor overseeing a wartime economy?
Going forward, it's going to be very cautious, very moderate.
I think it's absolutely vital that we send a very clear and unequivocal message to Iran. This behavior is unacceptable.
That's an important part of the world for oil supply. And traditionally, when risks elevate in the Middle East, you see it reflected in markets. We've not really seen that yet.
Ukraine's just not on the front page anymore, particularly after the tragic events that took place in early October.
President Zelensky is here, and he's really trying to rally the West once again as they go into 2024 without the money they need to continue fighting Russia.
Even just the defense spending of the United States and the sum of money allocated to Ukraine, it's, to say the least, a very little part of the overall defense spending.
Since 2014, allies have increased the defense spending substantially, but after the full-fledged invasion in 2022, of course, they started to do even more.
This was exactly Trump's main issue, that we were not spending enough, and he was right.
Macron said that 2024, 2025 is all going to be about how Europe can be more sovereign, whether it's AI, whether it's investment.
What proportion of some of these AI companies and initiatives do you think are actually going to come to fruition and be valuable.
The technology still has a ways to come, but I think it'll be just as revolutionary as the internet was.
I think it would be a terrible shame to throw away the most powerful tool we have for producing a productivity surge and growth.
AI, if it's going to transform our working lives, do you think we're just more productive but do even more?
They used to have to get up at 4 a.m. in order to write the report. Now they can get up at 5 because they've got a first draft courtesy of AI.
All the banks, their CEOs have been so optimistic about what's ahead.
Here we are flourishing, and so my job is to keep going what James has done so brilliantly.
That was some of the best from Davos, Switzerland at the World Economic Forum. Part of that story, investors paring back rate cut bets for 2024. Morgan Stanley's Seth Carpenter eyed the middle of the year, writing this: "We look for Fed discussions at upcoming meetings resulting in a June start to taper. Earlier than our previous expectation, but the market narrative that the end of QT is coming soon has been overdone. Earlier start will be paired with a slower taper." Seth Carpenter, I'm pleased to say, joins us now for more. Seth, wonderful to catch up with you, sir. Let's get straight into it. The Federal Reserve likes clean sequencing. It's why they waited. Before they started hiking interest rates, they had to wind down QE. Can you just walk us through the QT then rate cut sequencing and the timing of that as well?
Yeah, I mean, I think they do prefer clean sequencing, but when it comes to rate cuts, right now, they've been clear. They want interest rates to be their primary tool for policy. And in that regard, they will take the data as they come and they'll react. So they prefer clean sequencing, but I'm not sure that it's going to be the end of the story. You know, they're looking at different things going on in the economy. Inflation's coming down. It's coming down decisively. The economy is slowing, but in our view, not falling off a cliff. And so they're going to be taking a read on that macro outlook to figure out when to cut rates. Our baseline is June, but the market's sort of, in my view, a little bit over its skis, looking for, you know, now a little bit less probability, less than half for March, but still high probability there. We think the data sort of pushed them off until June. A different part of their conversation is about their balance sheet. So they have said, literally for well over a year, that at some point they'll slow things down. And the indications they've given us is that the key to slowing down that balance sheet unwind is when the reverse repo facility, that place where money funds are putting their cash with the Fed, once that's been drained down to zero, then they're going to look for a slower pace of things. So they actually are going to have to do a little bit of walking and chewing gum at the same time, but they've been planning this for long enough that I think they can do it.
And this is really going to the heart of some of the quantitative tightening going on. You think that they're going to have to taper it potentially even before they shift and adjust their rate cutting type of schedule. Have you been surprised by how resilient things have been? Are you concerned more now than you were 3 weeks ago about a reacceleration of inflation?
So I'm not really. We've had literally since the first quarter of 2022 a soft landing call. And so Ellen Zentner, my U.S. economist, and her whole team, they've been doing lots of great work. The labor market this cycle is just different than lots of other cycles because we came out of COVID. We came out of a pandemic. Firms are still playing catch up right now. They're finally back to the staffing levels they need. Hiring's coming down, but firing is not picking up. And so in that regard, we feel good that we're not going into recession. On the other hand, if you do any sort of smoothing to the data, things are slowing over a 6-month, 1 year, 18-month time horizon. And so we think we're on this glide path. I don't think we've been swayed too much in one direction or the other by recent data.
All we can say is that after coming back from Switzerland, everyone was just talking about how artificial intelligence will make all of our jobs happier, better, and more productive, and that this is going to be the reason why they are all so optimistic. I'm only talking about the doers, not the thinkers, who are all very pessimistic. But I'm curious, from your vantage point, how much are you modeling this into your sort of soft landing thesis? How much is it driven in part by this idea that technology is going to allow a greater efficiency and a greater productivity?
So I'm a buyer of the story that there are productivity gains to be had here. I think the real question, though, is one of timing. So I think so far, my view is the soft landing thesis is somewhat independent of the AI/productivity gains part of the story. I really think it's going to take probably another year, maybe another year and a half before we start to see those really come online. It can't hurt. It will obviously be disinflationary. It will obviously be supportive of growth. I think over the long run, it's actually going to be supportive of real wage gains for labor as well. The challenge, though, is going to be how that transition is managed, because there will be, in the short run, clearly some winners and some losers.
Seth, can you help us draw a distinction between correlation and causation? I get that rates have come up, and I understand that inflation has slowed down, but how connected are the two?
I think there is some connection, but it's nowhere near as much as maybe there would have been in previous cycles. So I think it's important to remember that this cycle, inflation took off, not because of the standard macroeconomic impulses. There was clearly some of that. The economy is running hot, has been running hot. The labor market's been tight. But goods inflation just took off because supply chains were disrupted, because consumer spending patterns shifted away from services towards goods, and that drove up goods inflation. That part of inflation has been going away on its own. Similarly, housing inflation shot up because of COVID. People wanted to live differently than they had been before, and we saw an level shift in demand for housing and housing. That inflation went up. It's starting to come down on its own. So there's a lot of the inflationary pressures that we saw that are going away independently of the monetary policy side of things. But to make sure it gets to 2%, and from the Fed's perspective, to make sure inflation stays at 2%, they have to tighten things to slow the economy down to a sustainable growth rate. And I think what we're seeing now is a little bit of the inflation coming down is from monetary policy. Prospectively, though, that's where monetary policy is really important.
That's what I'm trying to get into, Seth, just how much of the slowdown that we've seen is actually due to the Federal Reserve. Because when I look at claims at 187,000, at unemployment south of 4%, shouldn't we be asking the question whether the Fed truly is sufficiently restrictive?
Well, I mean, I think that's a valid question. We should always be asking ourselves that. But look at the housing market. Clearly, housing activity has come off dramatically. New home sales are doing fine simply because there's no supply of existing home sales because people don't want to give up their low mortgages. So we're seeing slowing there. We're seeing some pressure in terms of hiring. Look at how much non-farm payrolls have come down from 6 months ago, from a year ago, from 18 months ago. So I do think we are seeing some slowing in the economy. The economy has been insulated. That same housing market story goes in the opposite direction in the sense that people do have low mortgages. Businesses had termed out a lot of their debt. So that fact is I think, undeniable. But for us, it's also part and parcel to the soft landing story. The Fed's not causing the economy to crash.
I am curious, Seth, just quickly, how much you're watching what's going on in the Middle East, but also the Red Sea, to understand whether that could cause inflationary pressures, if there are longer wait times, if that does create supply chain issues once again.
Crucial question, and I think it's in the news for a very important reason. I mean, a lot of global trade goes through that region. So far, we have seen shipping rates go up. So I think unquestionably the direction of the effects on inflation is there. It's clearly going to be a negative for global supply chains. But, and I think this is really important, we've seen a lot of trade diversion as well. And so even though we are seeing some higher cost of shipping, once we put it through our measure of a global supply chain index, it shows a tick up, but nothing like a reversal of the huge gains that we've made so far. So we think for now, as long as things don't get dramatically worse, as long as we don't get an entire regional conflict, it's going to have only modest effects on inflation for consumer goods.
And finally, just because I'm looking for some kind of holes in this sort of Goldilocks theory that everyone's talking about, I am wondering just internationally how much, as John was mentioning before, the U.S. can remain the lone engine when you have China that seems to be, if not falling off a cliff, certainly sagging in terms of economic growth. Is the U.S. that immune to the slowdown that we're seeing in Europe and also in particular in China?
So not immune. We are looking for a slowdown. We're not saying that the U.S. economy is going to be ripping, but we are pretty optimistic. When it comes to China, no question, China's at risk. And we've been saying for a long time, China's at risk for a multi-year slowdown from a debt deflation spiral. But for the U.S., our exports to China are heavily weighted towards agriculture. There's a lot there for the consumer to sort of buy. I'm much less worried about China as a downside risk for the U.S. Economic outcome than I am about, say, some blow up in financial markets.
Hey, Seth. Great insight, as always. Seth Carpenter there of Morgan Stanley. Seth, appreciate the update. Just want to pick up on your point, Elisa, on what you had to say about shipping and the prospect of maybe goods inflation picking up again. Torsten Slok, Apollo, over the weekend writing this. Normally 200 ships travel through the Suez Canal from south to north over a week. That number has recently declined to 100. It's not just the Suez Canal where traffic has been an issue. Panama Canal as well because of water levels. Northbound traffic has declined 50% from 90 ships per week to 45. Asking a question about upward pressure on goods inflation in months to come.
And frankly, this is sort of the unspoken truth. It has a much greater effect on Europe than it does the U.S. So is the U.S. going to really have the emphasis on ending some of the Houthi involvement, because the U.S. isn't going to suffer as much as certain goods to Europe? We've already seen certain suppliers, certain manufacturers, Tesla in particular, shift some of the manufacturing away from Europe because of some of these issues.
You saw what the president said over the weekend. Is it working? No. Will we carry on? Yes. Now, this raises a question. Is this about ability or willingness to contain this issue in the Red Sea?
I think it's about willingness. They don't want an all-out war with an Iranian-backed proxy group. This is why they're struggling in the region. This is also why they would like to see an end to this war, and they're putting a ton of pressure on Benjamin Netanyahu, who is saying he doesn't agree with what the U.S. wants, which is a pathway to a two-state solution.
That's the latest on trade. Let's get you an update on some of the stories elsewhere this morning, and say good morning to Danny Berger. Morning, Danny.
Good morning, John. Macy's is walking away from a $5.8 billion takeover bid. Investors Arkhouse and Brigade Capital had offered a deal that represented about a 19% premium to Macy's closing on Friday. However, Macy's board had declined to provide due diligence to investors. Arkhouse says it is, quote, highly motivated to make a deal. Billionaires Chris Hohn and Ken Griffin are leading hedge funds to one of their best years. Hohn's TCI and Griffin's Citadel together raked in $21 billion last year. The industry as a whole produced $218 billion after fees. That's according to LCH Investments. Their report also shows that the large multi-strat funds are dominating, the likes of Citadel, Millennium, and D.E. Shaw. Meanwhile, the SEC is investigating B. Riley's financials deals with a client linked to securities fraud and the use of his assets to help the bank obtain a loan from Nomura. Bloomberg learned that the agency has conducted interviews about the firm and its relationship with Brian Kahn. Kahn is also involved in a DOJ criminal case related to a multi-billion-dollar hedge fund fraud. Shares of B. Riley are down in the pre-market trade. And that's your Bloomberg Brief. John.
Danny, thanks for that. Coming up on this program, equity markets facing some questionable earnings.
Earnings has been a sort of a puzzlement thus far. Obviously, you've had mixed results. It looks like this is shaping up to be not so great a quarter.
The attention turning from the big banks on Wall Street towards big tech on the West Coast. That conversation coming up next. Live from New York City, equity markets shaping up as follows on the S&P 500, positive by a third of 1% going into the opening bell in about 42 minutes' time. Under surveillance this morning, markets facing some questionable earnings.
Earnings has been a sort of a puzzlement thus far. Obviously, you've had mixed results. It looks like this is shaping up to be not so great a quarter. But what's really important is, again, as much of the last year, how the stocks react towards the earnings numbers. And it's not at all clear, given the run we had, that there is much more upside, even if you get the beats that are expected.
That was Julian Emmanuel of Evercore, leaving behind some of the big bank earnings. Lisa, looking ahead to the financials, or rather big tech, in the weeks to come.
Well, they basically are financials, given how much cash they're throwing off, and they're probably investing it in money markets and getting a sweet 5% return. What I'm focusing on is just how much earnings growth they're expecting in some of these behemoth Magnificent Seven tech earnings. Of course, kicking off with Netflix and Tesla and Intel this week. The so-called Magnificent Seven are expected to deliver combined profit growth of about 46%. This, according to Bloomberg Intelligence. That's down slightly from the third quarter's 53%. But nonetheless, it highlights why people are hiding out in some of these names. And you can see a huge divergence. AI, NVIDIA, up 20% year to date. And you can see Tesla down 14.6%, Netflix kind of meandering down 0.8%. This divergence really stemming from who's throwing off cash and how much that's really going to determine performance.
This is where the earnings growth has been.
Exactly.
We've drawn comparisons to this period and the dot-com boom, then bust in the late 90s, early 2000. There's real earnings here. And I think that was the difference with NVIDIA last year. When they came out in that quarter, raised the outlook, and you saw that the monetization of this theme was real and present, and it was happening right now.
That, I think, is the key, right? People can sort of poo-poo some of the rally that we've seen, but the bottom line is that's where the earnings has been, and they are monetizing it. With NVIDIA, though, how much is an outperformance baked in? Because remember, if they don't give some sort of crazy outperformance, then crazy increased forecast, people will be disappointed.
Yeah, it's got to be beat and raise and then beat and raise. Gina joins us now. Gina Martin-Adams, the Chief Equity Strategist of Bloomberg Intelligence. Gina, good morning.
Good morning.
Any reason to believe the leadership changes anytime soon?
It should change as the year progresses, but not anytime soon, right? So anytime soon being within the next quarter, very unlikely, because the rest of the S&P 500 outside of this Magnificent Seven is still struggling to post any kind of earnings growth as of the fourth quarter. We could see some transition into better language emerge from these companies, some confirmation that the trend will shift with the first quarter earnings season. I think it's more likely it's not going to come till the second quarter earnings season. Comps get a lot easier for this group as the year progresses, though. So it seems almost inevitable that we will start to see growth out of the 493 in 2024. And that rotation trade has really yet to exhibit itself.
I feel like we should coin this. It's like Magnificent Seven and the less magnificent 493. Yeah. I am curious how much the tech earnings really are going to set the tone in a pretty massive way, and how high the bar is for some of these companies.
Well, so first, let's take a look at what's actually happened during earnings season, because as much as financials may have created some confusion because they did have really big one-time charges to support the FDIC facility when the banks failed a year ago. When you exclude those one-time charges and you look at operating earnings, which is what analysts do, financials are beating hugely in the fourth quarter. Financials are actually on pace to post 2% earnings growth. The consensus was anticipating a 2% decline. So they actually set a pretty positive tone, but we got those unfortunate reminders of SVB's failure, Signature Bank failure. We got unfortunate reminders that financials are facing these charges, and that created a little bit of confusion. But to have 85% of companies beating expectations, it does tell you that even for financials, expectations were relatively low. Now, for tech, expectations have improved a little bit over the last week, but that's only because TSMC came on a beat. Tech expectations were actually also coming down along with the rest of the market through the fourth quarter. TSMC came out and beat in the middle of the week last week, and that created some uplift, but very little uplift in expectations even for semis. So the bar, believe it or not, is also quite low for semiconductors. If TMC can beat revenue growth and guide higher, almost every case since 2015 in which they've done that has resulted in a massive beat for the 10 largest U.S. semiconductors as well.
John asked you about a broadening out in leadership. What are you looking at in all of the earnings to understand whether we can start seeing that sooner, or just what will trigger that shift in some of the positioning? Yeah, I think really importantly, you want to watch what's happening in the U.S. industrial sector. This is the area where I think investors tend to overlook it. We all know that tech is starting to grow and broaden there, right? This is not just the Mag 7, but this is going to be a bigger, broader tech recovery. It does appear that that's likely. We know that financials is likely past its earnings trough. So those sectors seem to be in really relatively solid position. Most analysts are not anticipating anything out of the consumer space anyway, so that's sort of a red herring. You don't necessarily need to watch consumer. What you really need to watch are U.S. industrials, because this has been an area of distress in the economic data, but not an area of persistent distress in the earnings data. So if U.S. industrials can continue to show much stronger earnings growth than the economic data would imply, that's an area of divergence that could create a great deal of optimism. If we can get transports recovering again, if you can get some of the leading indicators of some of the more interest rate sensitive sectors improving, that would be a very, very strong surprise to consensus expectations.
Gina, let's just finish there. I'll throw in another piece of this as well. The relationship between stocks, the data, and the bond market. Last week, yields up, data good.
Yeah.
Last week, equities up, data good. Is there any tension there? Can that stick?
I think it can, because frankly, equities and bonds are both anticipating one thing, and that is slower growth and slower inflation this year. So the upside surprise to growth could very much fuel equity prices, because broadly, the equity and bond market very consistently are saying we're going to have slower growth and slower inflation. If you get the upside surprise coming from growth, the equity market should rise pretty materially. The upside side surprise from potential inflation is the bigger risk, and that could create big disruptions in the bond market and the equity market. That seems unlikely in the very short run. We could start to get upside surprises to inflation over the year, but it seems quite unlikely right now.
That would be a major game changer. Didn't see that last week, but that would be a major game changer.
It would. I am curious with the bond stock correlation, whether we are going back to the 60-40 or whether this is just sort of a breach point before we have a more significant move. I mean, the moves have been sort of tepid relative to the 20 basis point swings.
It's 1 week of price action, but at least last week yields up, data good, and stocks performed. Gina, it's good to see you.
You too.
Thank you.
Thanks
Gina, Martin Adams of Bloomberg Intelligence. Coming up at 3 p.m. Eastern Time. Don't miss this conversation. Bill Gross, the PIMCO co-founder, to weigh in, Bramo, on this bond market performance.
Yeah, does he still lead in or lean out of bonds? At a certain point, the buy the dip theory is all predicated on this idea that over a longer term, the Fed's going to cut rates, that the U.S. economy is going to slow. It raises a question for stocks, too, though.
Counting you down, not just to that conversation, but to the opening bell as well. That opening bell is just around the corner. Your equity market on the S&P 500 is positive. Live from New York City this morning. Good morning. This was Bloomberg Surveillance.